Okay. We are good. We are recording.
Welcome, welcome everybody. We are so glad you are here and hope you enjoyed your Labor Day weekend. This is the CE class that is it is FHA Financing 101. It is GREC course number 65973. And the instructor, we are so excited and so lucky to have Wes Barclay with Home Star Financial Corporation. And Wes is just going to get started in just a minute. CE credits will be recorded within 3 to 5 business days. We have to put together the registration report, the attendance report. Zooms keep track of who is attending and how.
You're not coming through, no sound.
Okay, we're going to keep track of that, and we're going to interact with you guys through the chat to make sure that you are paying attention. But you guys, these 3 hours are going to go by so quickly because the information is great. And I'm telling you, you're going to want to take this class again because FHA changes very, very quickly. But let me read the notice to students with you, and then we will get started with Wes, and he's going to introduce himself, and then he will get started. Please ask your questions in the chat. Please keep yourself muted so that everyone can hear Wes as he is instructing. So these CE credits are offered through the Georgia Real Estate Academy, which is GREC school number 6915, and the end date of registration currently is December 31st, 2022. This is a virtual remote broadcast of an approved in-class class for 3 hours in CE credit. There is no homework, and there are no pre-required courses. Again, the instructor is Wes Barclay of Home Star Financial Corporation. All students must be on time and present for the entire remote instruction period of the class. Students may only receive credit for a specific course number once every 12 months. If you've already received credit for this course, you are welcome to stay for, as I said, the updated information, especially with FHA, but you will only get the 3 hours of CE once every 12 months for this specific course number. There's no recruiting for employment opportunities for any real estate brokerage firm on this class or on school premises. I'm not quite sure how GREC interprets that through Zoom. If so, please report them to me. Again, my name is Dana Sparks. I guess I should have introduced myself. I'm the director of the Georgia Real Estate Academy, and the coordinator of the Georgia Real Estate Academy is Heidi Kelly. Again, everyone, you have your own ability to mute yourself, so please mute yourself. Please ask your questions through the chat, and I'm going to let Wes introduce himself and get started. So Wes, whenever you are ready, we are
Awesome.
good to go.
All right. Well, thank you so much, Dana. Everybody can hear me right now? We're good, right? Thumbs up. Good. Okay. So I'm Wes Barclay, and I'm sorry that we can't be in person for this meeting today. We're just virtual. I did try to make sure that I had a very blank background here so that no one can like locate my position and stuff, just in case you guys really think the course stinks. That's a joke. But anyway, so also virtual, normally we have like a sponsor comes in that brings in breakfast. The virtual breakfast is not quite as tasty as an in-person breakfast. So we're gonna make the best of this though. And I'm gonna go ahead and share my screen here with everybody so you can kind of see our slides. And this course is FHA Financing 101. So just a little background. Okay, present. A little background on me. So I was actually, I've been doing this for a real long time. I'll start off by saying it's been 20 years now that I've been in the mortgage industry, and I've done all kinds of different roles in this industry. But namely, I was an FHA or a DE underwriter, is what they call that, for 7 years. So I know my FHA guidelines extremely well. I had to approve these things and manual underwrites and all the rest of that. I'm a husband of 15 years to my beautiful wife, Melissa, and we have 5 children. So I play drums, you know, but I really just play at this point. I went from being, you know, cool rock star drummer to now I just play for kids at church. So I'm pretty involved with our local church over here. And then I'm also a baseball coach. So between that work and music, that pretty much takes up most of my time. Our goals for this course, we want to review and become familiar with FHA guidelines. And then we're going to talk about some of the changes that FHA's had. As Dana mentioned before, FHA does change. So we want to make sure we keep you guys updated on this. And it's definitely a good idea to you know, not just take the course and think you got it for years and years, but to kind of stay up to date on all the changes. Explain how FHA loans work on HUD homes. And we're going to learn how to set expectations regarding cash to close and money process for both just regular FHA loans, but also HUD REOs. So there's some nifty things that you can do on HUD REOs that, you know, for that customer who maybe doesn't have a whole lot of savings, but could afford a home. So repair escrows, do's and don'ts, and what kind of what we need and what we can get around. We'll discuss the rent changes, the recent changes in FHA guidelines. We'll review 203K loans, which I actually used to underwrite 203K loans also. So I've got a pretty large amount of knowledge when it comes to those. And then how 203K changes for HUD homes. So and I want to create just an overall, I want you guys to walk away from this feeling very confident with FHA. So that we can all increase our business, which is really what we're here for. So the characteristics that can cause the greatest increase in a real estate agent's commission is a lender that truly knows the FHA loan program. So you'd be amazed at how many loans that I get in FHA where someone had told a customer that they couldn't qualify, and it was really just because of a lack of understanding of how FHA program works. Well, that's a person who wasn't going to be able to get in a house and a seller who wasn't going to be able to sell their house. So it's so important that you understand this program for yourself so that, you know, if somebody tells you no, you kind of understand that, wait, hold on, does this line up with what I learned in the CE course, or does this seem kind of bogus? You know, so that you can maximize how many homes you're selling, you don't lose one. All right. I want to step back too. I'm going to be checking the messages fairly often. Probably I'll try to do it every maybe half hour. And if you have questions, go ahead and list those in the chat, and I will go over, like I said, periodically, and then we will you know, we can discuss the questions and go over the answers. So
before you go on, there is a question about if you will be emailing the PowerPoint. And
yes,
if you send that to me, you guys, I'll put in the chat where we post any handouts. We are also recording this. So as soon as we get the recording rendered and up, that will be in the same place. So just keep your eye on the chat, and I'll let you know where you can find a copy of the not the PowerPoint itself, but the PDF slides of the PowerPoint, as well as the recording.
Yep.
So thank you, Wes.
No problem. All right, rules, guidelines, overlays, and risk management. So FHA guidelines, which are it's just a set of rules or principles that FHA wants all their loans to meet. And these can be found, it's no longer in the 4155, it's now in the 4000.1. And all this is just a list of all the rules, what credit requirements you have to meet, what income requirements you have to meet, and then you know, what kind of assets, the property, which would be an appraisal, all of these things that FHA requires in order to insure the loan. And what does that mean to insure a mortgage? Well, that just means the FHA is saying, hey, we're good. If this person defaults on this loan, they don't pay it, we're good. We'll cover you as a lender. And lenders need that so that they can you know, have confidence in guaranteeing these loans and underwriting these loans. And they know that, hey, if we meet these guidelines, if we follow these rules, then this FHA will insure this this particular loan, and that gives a very high confidence to buyers buying these things, investors buying these loans on the secondary market. So every lender is going to make sure that they meet these guidelines for an FHA loan. Unless they're doing some kind of portfolio, which you don't see that a whole lot other than banks, and even those, they have their same guidelines. But for FHA loans, we have to meet the HUD 4000.1 guidelines. Updates to the handbook are provided in the mortgage letters. So whenever there's an update, we get a little mortgage letter that comes in, and you can kind of see that for yourself and see that what these changes are. And just so you guys know, the 4000.1, it's not like a lender. We don't have to have some special security clearance that we get from the White House or anything like that. It's actually available for everyone to see. So you can get on and see for yourself what the guidelines are, and then just get real comfortable with Control F, which is the control find feature. And then you can type in keywords, whether it be income or assets or whatever it is. Gifts, if you wanted to see, hey, what do I need for a gift? What's allowed? What's not allowed? You can go in there and look at it for yourself. And I always encourage new loan officers that are coming up not to play the telephone game. And what that means is where you ask somebody, hey, does FHA allow a gift on a loan from just a friend? And that person says, I don't know, let me see. And then they ask somebody, and then the person they ask actually asks somebody, and then it gets relayed around to 3 and 4 people. And we all know how that works. It changes every person that it hits. So go get the information. It's right there that you can get it for yourself. That way you're not just relying on somebody else who heard it from somebody else who heard it from somebody else. So it's all right there on the internet, it's a beautiful thing. So approved lenders underwrite and close FHA loans without prior FHA review or approval. So when we say DE, this is what I was. That stands for direct endorsement, if you will. And that just means that FHA has approved you as a lender, and they are endorsing you to make the decisions on their behalf. Lenders can set individual guidelines, overlays, and most lenders do. And what does that mean? FHA has a lot of you guys don't know this. The minimum FHA. Actually, I'm gonna see if I can't get this on the chat real quick. So anybody post in what they think FHA's minimum guideline requirements are for credit score. Does anybody have any idea what FHA requires from a credit score, what their minimum credit score? And I'm going to stop sharing for a second because I want to see. I see 640, I see 580, I see 650, 635, 600. So these are all pretty good answers. I'm not seeing the correct answer yet, though. So it's actually surprising. So not surprising you guys didn't know. This is one of those things you probably wouldn't. FHA's minimum credit score requirement is actually 500. So lenders put on their overlays. Did somebody say 500? I'm sure somebody clapping. Anyway, Brooks, is that you? Okay. Yeah, so it's actually 500. There's lenders put on this 580. And so all these other numbers are just numbers you've heard from your lender, but that's actually an overlay. Lenders will put on overlays, which is their own guidelines, and they do it to offset risk. So it's risk mitigation. So when you see a 580 score or a 600 score, ours right now is 620. It used to be 580 before COVID. And for those of you who don't know, the reason that changed was not because FHA thought that they were going to get COVID, they needed to up the credit score. It had really nothing to do with it. Was a kind of a indirect cause of COVID. Because of COVID, people were out of work, and because people were out of work, the government passed what's called the CARES Act, saying, hey, you know what, we're going to get forgiveness here on rent for a while, and for mortgages where lenders were told that they can go into forbearance. Which, by the way, forbearance is not forgiveness. I think we all know that right now. But because they did that, we had a whole bunch of investors say, hold on, we're not going to get paid for 6 months. So forget that. We'll just pull out and we won't invest. We won't buy these FHA loans. And so what happened is that made it one of the big investors that did that were insuring most of the 580 loans. And now we only had maybe one investor where we had 2 or 3 before that we could sell to for that bucket of credit scores that were 580 to 620. Well, because we didn't have a whole lot of people to sell it to, if you end up taking it to one and for some little thing it doesn't meet their guidelines, we couldn't then turn it to the next one like we normally could on an FHA loan. So that created a lot of risk, because if we can't sell a loan, then we're stuck with that loan on our books, and that's a big issue. So what lenders started doing is saying, okay, well, man, we're just going to mitigate this risk, we're just going to go ahead and say we're not going to do loans from 620 and below now. And that's kind of how it happened. It was more of a sub result of COVID as opposed to like a direct result from it. So little tidbit of information there for you. I'm going to get my screen back here now. Ooh, okay, so that would be an example of overlays on guidelines. This would be where the lender says, yes, FHA has these guidelines, but we also are going to take some our own actions and say, hey, we're going to put these our own guidelines in play. So thank you guys for responding too. It's good participation. All right. So overlays and risk management. Why is this so important? HUD can terminate a lender's underwriting authority. So if you have loans that go in default or too many loans that go in default, HUD can say, you know what, we're not allowing you, we're going to pull back our direct endorsement of you. And now then we won't be able to underwrite FHA loans like we would. That wouldn't be a product we'd be able to offer anymore. And we do a lot of FHA loans. I think, I can't remember if last year we were in 2019, but I know in 2018, we were the #1 purchase lender of FHA loans in Georgia. And that's some big hitters out there. That's, Wells Fargo and Fidelity's and all the rest of that. We were able to beat them. So that's a large percentage of our loans that if they were pulled back, no company could sustain that. So it's really important for all lenders that they keep good standings with FHA. So think of it as like a buffer when a mortgage lender, we don't want to go all the way down to 500 because then we have left us no buffer in case a loan goes south. So HUD reviews lenders' default rates every 3 months. And then your first 30 days within the last 12 months is a default. So if you've gone 1 by 30, I actually had this happen on a loan of mine. Actually, it was a Max 1 loan too. Customer was great. Everything looked good. And they called in and said, hey, you know what? I got a call from our secondary saying they didn't make their mortgage payment. And I was kind of like, what? And I come to find out he just lost his job like 3 days after we closed. And that kind of stuff happens from time to time, but we were able to work it out and get everything caught up and get it explained and, kind of let FHA know. It doesn't happen very often with us. And that's why we've had a great standing with FHA, but every now and then stuff happens, So HUD reviews are within geographic areas. So Atlanta is compared with Quicken and Wells Fargo. So you're going to see a lot of those in this Atlanta area because that's some of the other bigger lenders in here. Okay, so the loan basics. So we have a 203B, which is your standard loan, 203Ks, which is your rehab loan, 221Ds, which you're never going to see. You're not going to see 234Cs, 245Ds, As hardly ever. The ones you'll see majority of the time are going to be 203Bs, and that's what we'll focus on here. You guys can do some research, but just for the sake of time, I'm not going to get too deep into that. The minimum down payment for an FHA loan is 3.5%. So this is a nice contrast from conventional, which conventional is 5%. Now, we know there are some programs with conforming loans where you can get away with only 3%, but for a conventional loan on a 3%, you either have to be a first-time home buyer or you have to meet an incredibly hard income limit. So if you're not a first-time home buyer with conventional, your income limit is like $60,000 a year, which is not very much. So typically somebody making under that amount falls more into that FHA bucket anyway. So, but again, here the other thing with 3% is that the mortgage insurance on a 3% loan for conventional is very high. So a lot of times, especially if you're in between that 680 score to 700, you're still going to be better off doing a 3.5% FHA anyway, just because your payment's going to be lower. So your down payment has to be the customer's own funds. So what it can't be, it cannot be borrowed funds. And I actually had just a customer just yesterday. We were talking about down payment, which is normally in that first conversation that we have, where we say, hey, you know what, this is this is how much you're going to need. I always have the same spill that I do with customers. I would say, hey, you know what, let's talk about your assets now. What you're responsible for as a borrower is you are responsible for your down payment and any closing costs or prepaids that aren't covered by the seller or the lender. So this is the conversation, not to tell you guys what to do, but that you really should be having with the borrower up front too. You know, the credit piece, all the rest of that, that's stuff that we can work out, but you can kind of go ahead and be preparing for that, hey, your responsibility is not just a down payment, but also any closing costs or prepaids. And when we say prepaids, I think most of you know, prepaids are your taxes and your insurance that the lender collects at the very beginning, so that way when your tax bill comes due, they have money in that account and they pay it for you. When the insurance comes due, same thing. It's actually their money that's sitting in an account that the lender manages to make sure that they pay the taxes and insurance. And I'm going to kind of go off on a little bit of a tangent here because customers will sometimes, you know, ask, hey, why do I have to have the lender do that? Why can't I do that? On FHA loans, you have to escrow. There is no option for waiving escrows. On a conventional loan, if you're putting more than 20% down, there actually is an option to where you don't set up an escrow account and the customer would just pay that. But why is it important? Why does the lender care so much that they want to be the one, you know, managing the taxes and insurance? Are they just control freaks? Are they trying to, you know, take over my finances? Well, that's not really the case. You know, with mortgages, the lender has plan A and plan B. Plan A is the customer makes the mortgage payment for 360 months or whatever it is, and we all live happily ever after, okay? So plan B would be the customer doesn't make the mortgage, and then we have to recoup our costs because they're not paying us back, and now we've got to figure out how to make up that $200,000 or whatever it is, whatever loan amount we had lended. And by the way, the lender does not want plan B. Okay, the lender's not in the business of selling homes. The lender's in the business of you know, lending money and then collecting on the interest or selling them on the secondary market or whatever. So so what happens then is the lender has to sell the home, and the lender sells the home and then recoups the cost. Well, if your insurance lapse, and let's just say, God forbid, a tree falls through the house, and then the customer says, well, man, I got a tree through my house. I don't have insurance. I have no way of getting this house back to living status. I'm just bolting, you know, deuces, you know, good luck. Here you go, lender, I'm giving this house back. Well, now the lender has a home that they can't sell to recoup their cost. So it's so important that that the insurance is to date. So the lender just says, hey, you know what? We're not going to rely on the customer. We're just going to collect that money, and we're going to make sure that insurance definitely stays to date. If the lender ever found out that the customer had insurance that had lapsed for whatever reason, they would get insurance for them. So, and then the customer would be responsible to pay for that. Similar with taxes. With taxes, if the taxes weren't paid, the IRS will slap a tax lien on the property. And, you know, when that happens, that tax lien automatically comes into first lien position. Well, first lien position means that tax lien gets their money first when the house is sold. Well, a $20,000 tax lien, that can make a big impact when the lender's trying to sell the house to get their money back in case plan B happens. So that's why the lender cares so much about the taxes and the insurance, because they're trying to make sure that their collateral, which is the house, is in good shape and they can sell it as is and just in case, worst case scenario, plan B happens and they had to sell the home. So that's kind of why they do tax and insurance, and just to kind of give you a heads up there. But back to the gifts. So the gifts, an acceptable source would be like a family member or somebody who has a significant legal relationship with somebody. That could be the adopted child, not just somebody that, you know, hey, I've been taking care of this kid for a long time, but somebody who has a legal adoption over a child. You know, it could be from a parent or grandparent or some kind of blood relationship. So, but that money has to be the customer's own funds. A gift does count. What does not count is a loan. So again, when we go over this at the very beginning with the customer, we go over those things. Hey, you know, where's the funds coming from? You need your money for the down payment, and you need for your taxes and insurance that they're going to collect, and any closing costs not covered. So when you're having that conversation with the customer, if they don't have more than their down payment, then that's the conversation you need to be having then obviously with the listing agent, saying, hey, we need, you know, all of our closing costs paid through the seller. So gets into the next thing, the seller's paid contribution or interested party contributions. You can do up to 6% So this is a shift from conventional, which conventional is actually tiered, depending on what type of transaction this is, what kind of how much money the customer is putting down. If they're only % or less down, well, you can only do 3% on a conventional loan. FHA is just 6% across the board, and you can do up to when it says interested party here, that means that somebody like the realtor and then the seller, that would be interested parties. So there's two types of mortgage insurance on FHA loans. So conventional loans have mortgage insurance, and this is where you get into the difference and what's better about an FHA loan versus a conventional loan. So an FHA loan has mortgage insurance, conventional does, but a conventional, once you get below 80% loan to value, the mortgage insurance goes away. The mortgage insurance is there forever. The other thing about FHA is the FHA has upfront mortgage insurance and monthly insurance, and it does not matter how much money the customer is putting down. So, excuse me. So the upfront amount is 1.75%. Now that number is important because that's what you're going to be putting on those FHA exhibits that you guys do. It's 1.7% for upfront mortgage insurance. Now that upfront mortgage insurance is financeable. So what that means is they just include it. They don't have to just bring an extra 1.75% at the closing table. FHA allows them to finance it into the loan. So what they do is they take 1.75% of the base loan amount, they add that dollar amount to the base loan amount, and that's how you get the total loan amount. And so you might see on a contract or it's you're not going to see on the contract, you're going to see it on really an application if you're ever seeing that for the customer. But there's a base loan amount in FHA, and then there's a total loan amount, and that's the difference of the two. The monthly varies depending on what your term is. So if you're a 15 year, it's a little bit different, but normally it's 0.85%. Now, you don't see the reason that that's usually it's 0.85%. You don't see a whole lot of 15-year FHAs happening. Normally, FHA loans are for people who maybe don't make as much money or have some credit issues. And typically that customer, and I say in general, because it's not always, or of course there's exceptions, but in general, that customer is wanting the lowest payment possible. And that's why they generally go for a 30-year mortgage. I can count on one hand in 20 years how many 15-year FHA loans I've seen. So this is a recent change, by the way, that 0.85%. And when I say recent, I mean within the last couple of years. It's been holding steady for the last 2 years. All right. Income must be stable. I'm going to back out of here real quick and see if I can go back to my chat log, see if I can figure out how to do this without not sharing. I'm going to stop sharing just for a second and look at the chat sub. Okay. 500, that's great. Okay, so I'm going to go over a couple questions here. Yes, that is correct. From Edward, thank you. Tax default, that's an issue. What is the max loan amount for FHA loans? This is a very good question, actually. So I'm going to try to share my screen here, see if this works, and I'm going to show you how you can find that, okay? Go back to my share screen, and I'm going to go to this. I think you'll be able to see this when I do it. Actually, I'm going to go to this Internet Explorer since it's already open. Okay, so how do we or FHA max loan amount? So there's a way, I think there's some slides that go into this too, but I'll go ahead and show you how you get there. You can actually just type in FHA max loan and limits. And what's going to happen, don't look at Quicken Loans. My goodness, don't do that. But you'll see one in here, hopefully, that's going to say HUD.gov right here. This one right here, if you guys can see that. Can everybody see that? Give me a thumbs up. Everybody can see it? Okay. So the FHA mortgage limit. So it's not like conventional has one loan limit. I guess it's tiered based on unit size. Or so if they were like, if it was a 2, 3, or 4 unit, there's differing. But for just one unit, conventional, it's the same. It's $510,400. So $510,400, and that's changed quite a bit over the last couple of years here. But back for the longest time, it was like 410 and some change. But with FHA, it's different. It's done by county. So let's just go by county. We'll just say Paulding, because I think that's pretty close to where we are at. And you can see here, so we did Paulding County. here are the two cities, and here's the loan amount. So the max loan amount. So for 1-unit families in the Sandy Springs, Alpharetta area, the max loan limit is going to be $401,350. Okay. So you can kind of see this is Ohio. You look at the state here. So that's not where we want to be looking. You know, it's not us unless you're doing a home in Ohio. But for the Georgia Paulding County limits, you'd be looking at $401,350. So that's how you would find it. It's just as easy as a Google search. And you want to do that based on the counties. I will tell you, most of them are about that amount. They're all pretty close. I'm just going to go to Cobb real quick, because that's probably another one you guys will see a lot of. Oh, that's the wrong place, not the code. Cobb. So Cobb, same thing, 401,350. Where you'll see that start changing is more like rural areas. So if you start getting out to, I don't know even the county names for some of these. I guess Bartow. Let me see if Bartow is different. I'm trying to think of like Rome, Georgia, and some of these other areas. I'm not really sure that. See if Bartow's got a. No, it's the same too. Again, there's only a couple of counties that are a little bit less. But you guys get the gist of it. You can go search the county if it's a different county that you look in. Just make sure. I mean, really, I don't know of any counties that are under that $300,000 mark. So unless you're doing something over that, you're pretty safe. Go back to questions. Okay, what would the minimum wage earn for FHA loans? There is no minimum wage earns for FHA loans. The only thing that there is you have to meet the debt to income ratio limits. So, and we're going to get into that in some slides. So I'll go over that. You want to try Fayette County? I'll do that for you, just because I'm feeling in a very nice mood here. Because Carol and Fayette. Nope, that's not what I wanted to share. You guys want to see my? That's not what you wanted. We'll go to share. Here we go. Where's limits? Okay. Oops. See if I spelled that right. I did not. That didn't work either. Oh, because I've got this, that's why. Sorry. I did spell right. Yeah, there we go. Okay, so we're looking for Georgia. Here's where we'll be looking. 401,350, same. Let's look at Carroll County, which I think is going to be the same also. Like I said, there's only a couple of like maybe it's Bibbs or something like that are they're different. Did I spell that right? Is there one L or? I got it. Okay. So C4 still 401,350 in Georgia. So again, you're gonna only see just a few that aren't that same amount. So all right. I'm going to kind of stop on the county. Sorry, you can look up Burke County yourself. You can probably do it even while you're on this call. But you guys kind of get the gist of it. Let me go back in here and go to FHA 101. All righty. So income must be stable for 2 years. So income is a very important piece, and this kind of gets into what we talked about, what that last question was about the income minimals. There's not really an income minimum. You just have to qualify for the loan. And I'll tell you, there's two different ways to qualify. You have what's called your automated approval. So an automated approval would be where we run the customer's credit, income, assets, and in through software that we have, which is called DU, or it's Fannie Mae's. It's direct underwriting is what they call it. And what it does is that it'll spit out an answer. And the answer is either going to say refer or it's going to say approve eligible. Refer means it doesn't like the credit and you can't use an automated underwriting system. Now, does that mean then customer can't get a loan? No, that's not what that means. It just means that it has to be a manual underwrite. Now, the manual underwriting guidelines are a little more strict. But just to kind of give you an example of when you might see something like that is, let's just say a customer has a foreclosure, okay? Well, the guidelines say you have to have a foreclosure removed for at least 3 years, okay, to be able to do FHA financing. Well, it gives a little caveat for, it says 3 years, but if there was extenuating circumstances, we can do it for 2 years. So what do I mean by extenuating circumstances? An extenuating circumstance would not be, yeah, boy, I just forgot to pay this thing for 4 months and, they came and got my house, what my fault? Well, that's not an extenuating circumstance. An extenuating circumstance is something that is beyond the borrower or the customer's control. I got in a car wreck and I was in a hospital, I was in a coma for 3 months and had no way of paying this thing. It's something that was beyond the customer's control that created a loss of income. So FHA does not like divorce as a reason. It's funny, conventional doesn't really have an issue with using divorce as an extenuating circumstance. For some reason, FHA does not like that. And I guess the thinking is, well, these are still choices you made. Now, of course, there are exceptions to that. Sometimes it's just literally nothing you can do. But FHA just doesn't count that as a reason. Normally, it's something medical. It's something that that somebody experienced, whether got sick or whatever, and couldn't work. So sometimes it's a parent got sick and I had to go and take care of my mom. They were dying, and I was out of work for a little bit because of that. And then, but they will ask to document things like that. So if a customer ever tells you, yeah, I had a foreclosure, but it's 2 years ago, but boy, it was because these things happened that were beyond my control. Prepare them that the lender's going to want to document that. They don't just like take your word on it and say, okay, good, it's all good. And what I always tell customers too, and this might be helpful for you, is if customers a lot of times will be like, boy, why are you asking for so much stuff? We're lending hundreds of thousands of dollars. If this was like a $20, like, hey, here's $20, just pay me back when you can, we'd probably just do a handshake and let it go. But it's not. It's hundreds of thousands of dollars, and it's super important that we have established that the customer can pay the mortgage on time, and that's really all mortgages are. It's just when a lender is doing the approval process, and you learn this when you underwrite. We don't know for sure what's going to happen in the future. So we try to look at the past and try to figure out what the future holds. We try to make an educated guess on, will this customer pay? In general, what you'll see here is the last 24 months is the best indication of what's going to happen over the next 24 months, okay? Typically people that display a certain type of behavior over the most recent 24 months is indication of what they're going to do the next 24. So, and you'll see that trend in here. With credit, they're looking heavily at the last 24 months. With income, they're looking at the last 2 years. On an application, that's what we require. We require a 2-year residential history and a 2-year employment history, because the lender has a huge interest in what this customer's done over the last 24 months. So that being said, income must be stable over the last 2-year history. And then they want to make sure that it's going to continue for at least 3 years. Now, what does that mean? They're going to continue for 3 years. Does that mean that we're going to go in there and we're going to try to trick the customer and tell us, hey, are you going to be at this job for 2 years or anything like that? 3 years, I should say. No. Generally, income or stable employment, we're going to look at the past 2 years. And if they've got a pretty solid job history, they don't have massive gaps in their employment, we're going to say, okay, look, they've had the last 2 years, they've had 0 gaps in employment. If they've been at the same job, that's even better. And we can say, the chances of them just also start job hopping here over the next 3 years is probably slim. So we're good with that. In general, unless the lender has evidence that the income is going to end, then we count it as good income. So, but what does that mean to have good evidence or evidence that, let me go back. What would be evidence of income ending? Well, evidence, actually, I'm gonna throw that out there as a question for you guys. So anybody have any examples of income that would be ending that we would have definite evidence that this income would be ending? Anybody?
Is it like child support?
That would be, yeah, that's actually an excellent example. I saw somebody else said SSI, I think, let me see, seasonal work would be a good one. Maternity leave, yeah, that's a real slippery slope, because lenders can't really ask like, oh, you're pregnant? Like, well, we're not going to lend you a loan. That they can get some huge trouble for doing stuff like that. So, but sorry, good.
Business closing.
Yeah, business closing, but that's kind of hard to prove unless we had evidence that they closed. That would mean they don't have income currently, So, I see somebody says
short-term disability.
Short-term disability would be one. That's another real slippery slope too, because lenders have to be real careful not to violate HIPAA laws, you know? So the lenders have to be very, very careful about not saying, hey, you know, hold on, what's your disability? You know, that we can't ask questions like that. Now we can ask for documentation to show that the income, that they have the income, and typically that those forms will tell us if it's short-term or long-term. So, but I heard some people say here on retirement, that is an excellent, contract work would be another good one. The thing with contract work is that's typically self-employed work. You're typically a 1099 employee when you do that. There are examples where that's not the case. I'll throw out teachers. Obviously, we all know teachers are contract work, but that's contract work that, I mean, it's just so rare that a teacher doesn't get a contract extended for the next year. So lenders don't even ask questions about that to where they're like, hey, hold on, you know, it's August. Well, actually not August anymore. It's July, and this customer, they're between contracts. They don't really do that. They just kind of say, oh, it's a teacher. You know, it's kind of assumed that this contract is going to continue. But somebody said retirement, and that's an excellent example. Not all retirement continues forever. So a lot of time retirement income will end within a very short period of time. Pensions can end. They don't necessarily for life. And general, when I should say in general, what lenders ask for is when there's retirement income, they ask for an awards letter from the customer, and that awards letter needs to state that income is going to continue for at least 3 years. Normally, it'll say that it's lifetime. Yeah, if there were concerns, I tell you, COVID wreaked havoc on the mortgage industries. We had to do some stuff differently because everybody was losing jobs. You know, they were being furloughed, and you know, lenders had to adjust and be able to shift to make sure that people were going to have income for the next 3 years. In general, what that shift looked like is if they were furloughed, it's fine. Just before we closed, we had to make sure they were back to work at a full capacity. So those are all real good answers. You know, the child support one is a great example also. I'm going to touch on that just briefly. So child support income would be obviously ends when the customer gets, when the child gets to be 18 usually. Now there are some exceptions there, and those exceptions generally have to do with college. The other would be if they were a disabled child. But how do you prove that somebody's going to go to college when they're 16 years old? You know, so when you get to 16 years old, that income's not going to continue for 3 years because at 18 it's going away. You know, so that can be challenging to prove, like at 16 that no, they're going to go to college and this income is going to continue. That is a very challenging thing, and I don't really have a great answer for you because it's more case by case. They would have to give some kind of evidence to the lender where it was reasonable that this person was this child was going to be going to college. But again, it becomes challenging. So I'm going to go back in here. Where is my share screen? Okay. All right, so income's got to continue for 3 years. The credit requirements are very flexible for FHA loans. They're much more lenient than they are for, say, conventional loans. Conventional, you have to have higher credit scores. In general, I mean, conventional loans go down to, I believe it's 620. It might be 640 right now. But it's so hard to get, especially on a purchase transaction, a loan approved under a 680 credit score, really. So that's in general what I tell people, especially realtors, because the times where you see loans approved with under a 680 score, it's normally when somebody's putting more than 20% down. And that's normally comes with refinances that you see. Most people who have lower credit scores is because they don't have a lot of cash, and that's why they're struggling to pay their bills on time. And or they have collections that have been put on them. That's not always the case. Again, I don't get offended. Don't hear what I'm not saying. I'm just saying in general that's the reason. So people that don't have a lot of money are typically not putting a ton of money down on a purchase transaction. So when you get into this FHA market, it's typically people who don't have a lot of money. What we get into is more need a customer who needs more flexible credit. FHA's minimum credit score requirement, it was 580. I think it will go back to 580 once we're 6 months. I believe the CARE Act lasts for 6 months. So I think when that goes away, which I believe that was enacted in June, it might have been late May. but I believe it was early June is when it was enacted. So we'll probably by the end of this year, we'll start seeing guidelines relax a little bit, and we can get back down to 580 again. But right now, like our minimum credit score is 620. I don't know what Wells Fargo is right now. I know for a while there they were at 580, I believe. I'm sorry, 680, which is crazy. And that basically takes almost all your FHA loans out of it and basically made them just a conventional lender, or I guess USDA also. But a lot of lenders went to 640. I don't know of any that went down to 600. I've heard whispers about some that do, but even when you get down to those low credit scores, the pricing hits on those are a ton. So what you'll find is rates are still pretty good on them, but the closing costs are a ton higher. And what that is just a lender offsetting the risk. I mean, these loans become very, very heavy risk, and they say, well, we'll take the risk, but we want more money for it. You know, that's kind of how rates and closing costs are derived. It's all based on risk. So seasoning requirements. Now, these would be the requirements for major credit issues, okay? The first would be a foreclosure. So like I said before, FHA requires 3 years being removed of a foreclosure. Now, when does that foreclosure period start? And when I say that, I mean from a lender standpoint. When do they start that 3 years count? Well, and this is very important, it starts on the day that foreclosure was recorded, not when the foreclosure happened. Now, this became a major issue back in like 2009 to 2011, really, when the housing market kind of crumbled. And what you saw was there were so many foreclosures in the market that lenders were having a hard time processing everything. So you'd see a foreclosure in, we'll say 2010, and it wouldn't get actually recorded till 2011, sometimes 2012. So what the lender gets for this is they get the foreclosure deed. That's the official document that you get that shows that it's recorded, and they're going to use the date on that foreclosure deed. So if you have somebody that says, hey, I had a foreclosure, it was 4 years ago. When the customer says 4 years ago, they're saying 4 years from the day they left the house. They just don't understand that there's a time where it actually gets recorded at the courthouse, and that's the date that the lender is going to use. And there can be a large time between those two dates. So it's important that if you get that, if you want to have peace of mind as a realtor, that you go ahead and get that foreclosure deed and kind of see. That way, you're not wasting your time on somebody who has no chance of qualifying. If you want to give me a call, I don't mind doing that legwork for you and reaching out to the customer. We do this a lot. And then generally what we'll do is we don't tell them no, we just say not now. And then we kind of figure out a date. We set an email reminder saying, hey, at this date, you'll be able to qualify. And what that is, that's future business. So I think it's foolish to turn people down, because just because they don't qualify now doesn't mean that they won't in a little bit of time. Sometimes it's just giving them some direction and saying, hey, you know what, this is how we can get you approved. It's just going to take a little bit of time. So
I've had some banks tell me they use the discharge date.
Well, that's for bankruptcies. So the foreclosures don't have discharges. Okay, hold on, let me back up. So if a foreclosure is included into a BK, it's a little bit different from a conventional standpoint. I don't think that FHA adheres to that. So FHA is going to adhere to the foreclosure date no matter what. On the break, I'll check that for sure. But at FHA, I know with conventional, if a bankruptcy is included if a foreclosure is included into a bankruptcy, so somebody files Chapter 7 bankruptcy and they include a mortgage in there, that is a foreclosure. But at that point, they'll use a discharge date, and it's only 2 years requirement. So so
the bankruptcy trumps the foreclosure.
Exactly. So they'll just count it as a foreclosure. That's kind of that's something that that's something that a savvy loan officer will look at, and not just say, oh, well, you have a foreclosure, that's less than 7 years, because on a conventional loan, it's 7 years is the requirement to be out of a foreclosure. So, but like I said, with FHA, it's 3 years from that discharge, from the recorded date. So 2 years after a Chapter 7, and there you go, you see the discharge date there. And then 1 year after Chapter 13 has been filed, and that's for that's the file date. So just for those who don't know the difference between a Chapter 7 and Chapter 13, Chapter 7 is complete forgiveness. Okay, so you just say, look, I'm done, hands up in the air, like I can't pay this stuff anymore. And then what happens is that you're free of all your obligations, and then you're kind of done with it. Chapter 13 is just restructuring your debt a little bit. You're basically trying to work with the creditors, trying to get lower payments so you can afford to actually pay them off, and then you get into a program with them. Well, you're not actually discharged from the Chapter 13 until you're done paying all the debts. But a lender will allow you to get done with the Chapter 13 to get financing, so long as you've been paying that Chapter 13 for 12 months and all your payments have been on time. So a lender's a little more lenient with this because they feel like, look, they're trying to make good on their payments, but they want to make sure that you're actually legitimately trying, that you have a history of that. So that's why they say 12 months. So there's no waiting period on a short sale if there's no mortgage rates. Otherwise, they're the same as foreclosure. Now, the problem with that is that very rarely will lenders, almost the first thing they tell you to do on short sales, or this is what I've always heard anyway, is that when the customer says, hey, I need to do a short sale. I'm sorry. Let me back that up. If a short sale is a little different. A short sale is where you're just paying underneath the amount that you owe because your value is upside down. You're not going to see a whole lot of those right now because people are values have been so good. You saw more of those back in 2008 to 2010 because values were getting just destroyed. But there's no waiting period on a short sale so long as there were no lates on the mortgage. A lot of times though, even when you try to do a short sale, the lenders will basically say, look, we're not going to let you do short sale because there's been no late payments on this. I've heard of people saying that. That's not quite as bad as when people are trying to do forbearance though. So let's kind of move on past that. There we go. Ancillary requirements, borrower must be a legal U.S. resident or permanent resident alien. Let me go back up one real quick. Okay, I want to make sure. Borrower must have a clear CAVERS. CAVERS stands for Credit Alert Verification Reporting System. And what it does, it basically tells the lender that you don't have any government debt out there that's in default. So if a hit comes up on CAVERS, you will not be able to get a loan. Quick little story for you. I had a customer who's actually a realtor, and he called me and he said, hey, I want to buy a house for myself. Here's my situation. And we worked on his credit just a little bit, got his credit score from a 550 up to like a 640. And he was ready to qualify. I have the kind of the same spill I go over on different things with customers just to make sure I cover everything. And one of them is the declarations, which is on the application. And it's a bunch of yes or no questions. And one of the question asks, are you currently in default on any government debt, such as student loans, bonds, anything like that? And his answer was no. Well, then we pulled the CAVERS, and the CAVERS came up saying, hey, you know what? There is a hit here. And so I called him up and said, hey, there's a CAVERS hit here on you. He said, you got a student loan that's in default. And his reply, I kid you not, was, oh, I didn't think that would be showing up anymore. So I had to, ask him. He's actually, we kind of have a relationship at this point. I was just there thinking, I didn't ask you if there was one that was going to show up. I asked you if you had one, period, because it will show up eventually. So anyway, we had to do some work, and it's challenging getting that kind of stuff removed. I mean, you basically have to pay it off, and normally they're large amounts. They're not just, $100. I mean, normally it's thousands of dollars. So it's very important that the customer is upfront with us and tells us, hey, if there is any, let us know now, because somebody who was much wiser than I told me years ago, if you're going to fail early. Don't wait until, a week out of closing and then realize you don't have financing. So federal tax liens can remain open if the borrower has arranged the payment plan and made at least 3 on-time payments. So, this is crucial. They have to at least made 3 on-time payments. So if you have a tax lien on your credit, it's not just, hey, let's set up a payment plan and then we can roll on. You have to have been in that payment plan for 3 months. So that can really delay a closing if they're not in a tax lien. This is something you can get ahead of. If you kind of have like a little questionnaire and you just want to make sure, like, hey, how do you think your credit looks? And they say, challenges, you can kind of immediately ask, hey, when by challenges, you mean you have any bankruptcies, you have foreclosures, tax liens, and kind of hit those 3 things. And they say, oh yeah, I got a tax lien and I've been meaning to pay for a long time. Hey, get in a payment plan right now. And then we'll just know that we're about two months away from closing, which really is only going to delay you about a month, because if you think about it, if they start a tax lien right then and they tax lien plan, sorry, payment plan, and they make that payment the day that they create that. So they get off the phone with you and they immediately call and they make a payment. That's 1 month payment. And then the next month's payment they would make within 30 days. So now you're 2 payments. Well, your closing, once you get a contract, your closing is only going to be 30 days away. So we just got to make sure sometime right before closing, we get that 3rd payment in there. So we really are only delaying. If you get ahead of this thing, you can make it to where you really only have a few week delay on your closing. But again, it really relies on you guys kind of getting ahead of this. So, and something you might just say, look, I'm going to, stay in my lane. I'm going to let the lender handle that. And that's fine also. So collections can remain open. You don't have to pay them off. But if the balance of all of the collections, so we have to look at all the collections. If the balances of all the collections are over 2,000, they must be counted in the payment, and you have to use a 5% payment. So they can either be paid off, or we have to count. We add up all the payments and multiply it times 5%. Sorry, add up all the balances, multiply that times 5%, and that's what payment we would use. If it's just a couple of $500 collections or even a $2,000 collection, not going to really hurt you. Anything over $2,000, you got to start using a payment. Disputed derogatory counts can create issues. So the way the guidelines read is that you have a disputed account and there's a balance of more than $1,000. At that point, the lender has to downgrade that to a manual underwrite. And we're going to talk about manual underwrites in a little bit. We hit on that just a little bit earlier. But that can create a big problem. It's something that's fairly easy to fix, but it can have impacts on your credit too. So the 90-day flip rule. So this is a big one for you, for realtors. If you've got a house that you're listing, and this is a person who, man, hey, I just did a whole bunch of rehab to this house, and I bought this thing on a steal. I put in new carpet, now I'm going to sell it for $100,000 more. That's an issue. FHA requires the seller to be on title for 90 days. So if it's not, it will not go FHA, and you need to make sure that if you're trying to sell this thing within 60 days, as a lot of people who are flipping homes do, at that point, you need to make sure that it's conventional financing only. Let me see if we've got any more questions here. Okay. That's okay. See if I can go up a little bit here. Nope, that's not how I do it. Chat. Go up. Okay. Would like a USDA class. Richard, good news. We do USDA class. I think that was just the last week's one too, or I think it was the last one I taught was the USDA class. That was 2 weeks ago. So just kind of make sure that you're looking at the updates coming out, because I think we have 4 or 5 classes we kind of cycle through, and USDA is one of those. So you just gotta catch it on one of them. The buyer's FHA loan. What can ask for the buyer lender to see if the buyer's loan will go through for sure? You can ask for, the pre-approval letter, of course. If they're approved through, if they're already approved through underwriting, that helps, because then you kind of know at least they have a credit. They've looked at the credit and that looks good. But I would say that the pre-approval letter, that's really all I would know to ask for. And what the question was is, hey, you're a listing agent. You got somebody who's doing FHA financing. What do I make sure that the FHA person is approved? I want to dispel kind of a rumor here. Just because that you have FHA financing does not mean that you have a lesser chance of not getting qualified than a conventional loan. I have seen zero evidence of that. Yes, that an FHA customer typically maybe doesn't have as good credit as a conventional, but there are also things that can keep a conventional person from qualifying on a loan. Most of the time, if you've got FHA financing on somebody, I have seen, again, about the same evidence that an FHA customer will fall through as I have a conventional. I have not seen a huge disparity in those numbers. So there's this kind of thing that sometimes people won't take an FHA person, just because they're worried about the customer not qualifying. If you're a lender, if you've got a trusted lender that you're talking to, and reach out to the lender. You can reach out to the customer's lender and just say, hey, we're considering this listing or this offer, and we want to make sure that this guy qualifies real well. and they should be able to tell you, they should be able to tell you, and you can tell somebody's, if he starts going, oh, ooh, yeah, man, I think it's going to be good. Hopefully, that might be a red flag. But if they're like, oh yeah, absolutely, this guy's golden, then that's fine too. You can also offer, you can also partner up with the lender. I mean, this is something that we do with some of ours, and you can say, look, I'd like you to use our lender for this listing in order for us to offer this. And if that's, me or Jay or whoever, give an incentive for that. Like I know that I'd be more than happy to partner up with people if they're, sending me some listings. And, if they want to do, we can do like some sort of credit towards closing cost, whether it be $500 or $1,000 or whatever. That's something that we've done before. So, but again, at that point, you have somebody that and I can say, yes, no, we're absolutely good. It's no different than what we do with our builder accounts. I mean, our builder accounts, like I'm the preferred lender for Smith Douglas, Smith Douglas has us do that because they know that when I say that this is good, they know this is good, and that this is not going to be something that falls over. That's what I've just built that trust, that they know, hey, look, I don't tell somebody I can do something if I can't. Somebody have a question? Nope, no questions. Okay. Okay, let's, we already did that one. Let's keep going down here. See the rest of the questions. Okay. Yeah, notes. If I'm a listing agent, the buyer has FHA loan. What can we ask? Okay, we already did that one. Can't hear them. Is everybody okay hearing me? Because I just saw somebody said they can't hear me. Anybody have any issues hearing me? Can I get a thumbs up? Can you hear me? Do I need to be louder? Am I okay? Okay. Yeah, maybe try turn the volume. Okay, so does the 90-day flip rule apply to USDA loans as well? No, that is an FHA specific loan thing, and we can talk about that a little more on our USDA loan. If anybody has any questions about USDA, I'm gonna try to stick with this with FHA because you'll hear me make some comparisons that really have to do with FHA. But contact me, give me a call after this, and I'll be more than happy to answer whatever USDA questions. I love USDA product. It's a loan that I have not underwritten before, but I still do teach CE courses, so I know a lot about USDA, and I do a fair amount. I just told you that I do a lot of Smith Douglas. I'm their preferred lender, and they have a lot of USDA neighborhoods, USDA eligible neighborhoods. So how do we know if a loan has gone through underwriting or not? You can ask for an approval. Ask for an actual loan approval, not just a pre-approval. Say, hey, do you have a conditional approval on this loan? And if they do, say, hey, will you send me the conditional approval? And see if the lender, I don't know that the lender has any obligation to send that to you, but you don't have any obligation to accept the offer. So you do have some leverage there that you can say, hey, I want to accept this offer, but but I want to make sure that I've got a good customer here. Okay. Hopefully that answers that question. Is there an age limit for qualifying? There's not. Well, sorry, you have to be 18. So you have to be an illegal adult. But there's no like age limit. So that would be discrimination. So we can't do that. All right, let's go back into sharing. Get back into screens. I'm going to take a break here, probably at 11:30, and then we'll let everybody get some water or whatever. It's a little different than class because you can just kind of walk away from your computer when you're doing these Zoom meetings. But still, I'll try to let it get caught up, and I probably need to get some water. I can feel my voice getting a little hoarse. Okay, so we're going to keep going down. Oops. Okay. 2 ways to get loan approvals, and this kind of goes back to what I touched on before: automated approvals and manual approval. A very good question to ask the lender is this automated approved, or are we doing a manual underwrite on this loan? Okay, and what that means is if you've got an automated approval, that's a little easier because it's not, you know that the information, so long as the information that was input into DU, the automated approval system, automated underwriting system, as long as that information is in there good, then you don't have to worry. You know the ratios are good and all the rest of that stuff. So the problem with that though is that information is only as good as the person putting it in there. So if they put in wrong information, they got an approval, there's a chance they could get a false approval. Now, what does that mean? That means if you have a loan officer who's not incredibly competent at looking at income, they could be looking at the income and say, oh, this guy makes a salary. I'll give you an example of a common mistake that's made. They'll look at it and they'll say, oh, hey, this person's got a salary of their teacher, and they just told me they make $5,000 a month, and I've seen the pay stub, and that pay stub has $5,000 a month on there. But then they find out they find out that that the customer only gets paid 10 months out of the year, as sometimes teachers do. Hold on one second. My boss is calling me here. I just tell them I'm teaching C course. So they would, sometimes they only get paid 10 months out of the year, as sometimes teachers do. And they use $5,000 a month, but that's not really what they're making a month, because there's 2 months of the year they're not getting paid. A savvy loan officer will ask the customer, hey, you know what, are you getting paid all 12 months of the year? Or they'll just ask for their annual salary, because an annual salary doesn't really matter how they divvy it up, whether they pay it out in 10-month increment or if they do it all 12 months. The 10-month salary, we would just take a 12-month average of that, and that's the income we would use. But that can be a big difference. So if you did that and you put in, $5,000 a month, even though $5,000 times 10 months is only $50,000 a year. Well, that's only like $4,200 of income a year. It's not a month. That's not $5,000 a month. So if you put in $5,000 a month, you might just barely get an approval. But when the underwriter gets that, they're going to do the right calculation on that. They're going to do 42 a month, and they're probably not going to get an approval at that point. So it's really only as good as the information that you put in there. So again, it's still a good question to ask though, because if at least if it's an automated approval, that the chances are pretty high. If it's a manual underwrite, that means the thing's got some issues, and there's a reason they're having to do a manual underwrite. Doesn't mean it can't get approved. Just means you might want to ask some more questions. Like, okay, it's a manual underwrite. Has it already been approved by an underwriter? And if the answer is no there, that would be a red flag. Unless you're in a desperate situation, I'd probably move on to that next person. So, or if you want to call me, like I said, I don't mind. This is what I used to do, is underwrite manual loans. I don't mind taking a look at it. Even if that loan isn't coming to me, this is something I'm willing to do, just being as a partner, especially for you Max 1 agents, to go in there and just say, hey, I'll take a peek at it. And they can send me the credit and their income, and I can look at it and tell you if they're going to qualify or not. So automated approval, it's the easy way. Because it approves the ratios for you. You don't have to go in there and make sure that it meets the credit approval reasons. You don't have to get compensating factors and all the rest of that stuff. The loan is approved through FHA Total Mortgage Scorecard. All that is really, it just looks at the guidelines, and it gives some, remember, their guidelines are not exact lines. So there is some leniency you can do. Let's just say the guidelines say, hey, we want the debt to income ratios to not be more than 42%, okay? But this guy's got a ton of assets. Okay, well, maybe then we're okay. Or maybe the guy's got some overtime income that, you really need that to be, you really need them to have this income for at least a year to qualify. Maybe they don't have that year, so we can't use it for our debt to income ratios, but we still know it's there. So it's a compensating factor. It's other income that we can't really use, but we still kind of know is there. So these are things that you can use to do a manual underwrite for, okay? So credit is acceptable with no additional on automated approval. Credit is acceptable. We don't have to get letters of explanation for anything. We don't need to have any additional review. The automated underwriting has already said, hey, this is good. We are good with this income, with this credit, I'm sorry. Rent does not have to be verified. That's probably the nicest thing about an automated approval. You don't have to go back there getting 12 months rental history and having a risk there of them having a late on their rent. Simplified documentation requirement. So you can get away with 1 month bank statement on an FHA loan. That would be an example, so long as the beginning balance and the ending balance is on there, which most bank statements have, by the way. Aggressive DTI approval. So for a manual underwritten loan, your max back end ratio, and I'm going to take a step back and kind of go over what ratios. When they say DTI, that's debt to income ratio, and it's just that. Is they take the income and they divide it by the debt. I'm sorry, they divide it into the debt, and they come up with a ratio. For a manual, the max that you can do is 50%. And with that 50%, you have to have compensating factors, like what I just mentioned. Maybe several months reserves, so they have a lot of assets, leftover money in the bank after closing. And that can't be gifted funds. That has to be the customer's own money. Or maybe they've got extra income, like I mentioned, that really verify, but we kind of know is there. We just can't use it because of a technicality. So you don't have to have that on an automated underwriting. An automated underwriting system, I can tell you, if you've got over a 640 credit score, chances are it's going to let you go, your debt to income ratios go all the way to 56.99%. So that's pretty strong, and it allows customers to kind of get in under much more lenient guidelines. So reserves are based on the approval. So whatever there are no extra reserves required. It's just whatever you put into the automated system. If you get an approved eligible, they're good with that amount of assets. So you also hear stuff say automated approval, an AE, a DU, LP, etc. So these are all just different ways that we run automated approvals. Manual underwrites. Manual underwrites, we have to have at least 1 month reserves. That's like bare minimal. If we need another compensating factor, we would have to get 3 months reserves on there. So, and this is where we get into compensating factors used to justify higher DTI. So if you don't have any compensating factors, your max DTI is 3143. 43 is that back end ratio. So what are the difference between those two numbers? The front number, which is that 31, that number is just as, that's your mortgage. They call that the housing. That's your proposed mortgage divided by your income. So whatever your mortgage payment is going to be, they divide that by the income, and that's how they get that. Your back end ratio, which on here is 43, is your proposed mortgage plus all your other debt. And when I say debt, I'm talking about borrowed money, things that you are obligated to pay that would count, like credit cards, things you've taken out debt. And there's no like, hey, I'm just going to stop service here, you know, and I'll get away with this. You can't stop service on credit card debt that you owe. You know, that would be called going into default. But things like your utilities, you're actually just paying for a service there. Those are not things that we count in the income ratio. Utilities, phone bills, these are just services that you pay on a month basis, and you can say, hey, I don't want this service anymore, and not have to pay them. There's no like payback due there. So with no factors, your max ratio is 31 over 43. With one compensating factor, your max ratios would be 37.47. And then with two compensating factors, the max is 40.50. So normally when you're doing manual underwrites, if you're not getting an approved eligible, most people don't have two compensating factors. So there's a reason they're not getting an approved eligible. So that's why this becomes much, much harder to obtain if you have high debt to income ratios. So something to be aware of. And here's some allowable things that you can use as compensating factors. Like I mentioned, 3 months reserves, and you cannot use a gift for that money. Little to no down to payment shock. So if your payment is increasing by more than $100, you can't use that. I'll tell you, most people's payment is increasing by more than $100. So residual income, that would be income after all of your payments, after everything you've paid all your bills. How much income do you have left over? And there's a dollar amount there. It's not a ratio. Typically, if you're having debt to income ratio issues, though, you're also having residual income issues. So that's another one that can be kind of hard to obtain. So again, just this kind of goes over residual income, which I just kind of told you. It's cash flow analysis that we do. It takes the gross income minus taxes, minus debt, minus housing payment, minus utilities and maintenance. And that's how we get our residual income amount. You'll see this more on VA loans, because VA always requires residual income. FHA, you only need it if you're trying to use it as a compensating factor. Here is what we use for the for what the residual income needs to be, and you can kind of see here if we're in that second table, unless you're doing a loan amount under 80,000, which don't see a ton of that anymore. But we would look at the family size here, and then we would look at what just happened there. Yeah, we would look to back to work. I'm sorry, the family size, and we're in the South, so we would look here. If we got a family of 3, we need at least $889 for residual income. So I'm gonna stop right there, and we're gonna take about a 10-minute break, and then we're gonna come back in, and we'll go back into this back to work program. Let's see if there's any questions. What is your definition of reserves? I heard a few different definitions. Okay, that's a good question. So what does it mean to have reserves? Reserves is all the money that you have after your down payment. That's the simply put. After the cash you need for closing. How about that? So let's just say that we look in your account and we say, hey, you know what? They've got $40,000 of assets, but they need $20,000 cash to close. So that's your down payment plus your closing costs and prepaids that aren't paid by the seller or by the lender. Well, we would look at that, the difference of those two numbers. So in that scenario I just laid out there to you, you'd have $20,000 of reserves. Now, what do they mean by months reserves? Well, months reserves is how many months of your proposed mortgage payment do you have? So in that scenario, I just said the $20,000 you had left over. Well, let's say your mortgage payment was $1,000 for easy math. That means you have 20 months reserves, because you can make that mortgage payment with that $20,000. You could make that mortgage payment for 20 months in a row. And that looks really good to a lender, because they feel like, look, worst case scenario, hey, you came into some hard times and let's say you lost a job. Well, for 20 months, you have sitting there in the bank mortgage payments that you can make. And most people will. Most people don't want to give up the house that they're in. On the flip side, if somebody has 0 months reserves, well, that looks a little bit risky, because then what do they do if they lose a job or run into some hard times? So that's if you'll notice, the common trend with mortgages is that it's all risk mitigation. It's the lender trying to say, okay, the lender's there to make money. It's just the way that it is. And the way they make money is by loaning people money to buy homes. So they just want to make sure they're getting paid back, and all will be well. If they're somebody told me one time, as an owner of a company I worked for a long time ago, early on, and it always stuck with me, a good loan is one that pays and pays on time. And that's really, it's simply put. So do I have any other questions? Underwriting, what's your definition of reserves? I answered that. Can you go back to the prior slide with DTI? Yeah, let me go back to that real quick. And then I'm going to leave it at that. I'll leave it there and we'll break. We'll come back. For some reason, my watch thought I was exercising. I have no idea. That means I'm running my mouth probably too fast. If I need to slow down at all, by the way, I have a tendency of talking quick. So if I need to, maybe just I don't know, yell at me, slow down, and I'll try to slow it down. Let me get back. It is 11:20 right now. Let's reconvene at 11:30. And I'm going to put this slide back up on that DTI so you guys can see it. And normally on my CE classes, I try to have candy and stuff, and I throw out. I've been known to bring some gift cards. It's hard because I can't figure out a way to send this gift card right through my computer and into y'all's. But hey, technology keeps advancing, so we'll see here. Maybe, hopefully, the Zoom things will be done, because I'm sure. I don't know. I'd rather do it in person. I'm just kind of an in-person guy. All right, let me go back to. Oh, there. I think that was the screen that they were wanting. All right, I will be right back too. I'm going to get me some water, and I will be back.
All right, everybody, please go take a break and be back at 11:30. When you come back from break, please once again sign in with your name, your email address, your real estate license number, and if you are attending via phone, please also type in your phone number. Also, I am sending through the chat afterwards a PDF of the PowerPoint and this video recording will be available to you, and the email, the URL, I just put in the chat. There's no login, there's no anything for that. It's not password protected. You just go to eagentweb.com, and then you're going to click on training videos, and then you're going to scroll through and you will find this class. There was a question earlier about the USDA lending class, and the Georgia Real Estate Academy did host that last month. So the recording of that and the handouts for that are available on that same website, eagentweb.com, and then you click on training classes. My pleasure. For those of you that are interested, there are a bunch of the classes that we teach through the Georgia Real Estate Academy. There are videos on there and a ton of handouts, especially a ton of handouts on the GAR contracts, on our e-forms contracts, and the handouts are all underlined and all of that. You are more than welcome to download any of the handouts that you want as a reference and watch the videos. Now, you're not going to get CE credit for just watching the videos, but If there is something that you feel you need to brush up on or just want some added information, feel free. We at the school, the Georgia Real Estate Academy, believe that the better trained, the more training that we have as real estate agents, the better it is for our profession, the better it is for any transactions that we do, and the better it is for our public. So we like to make all of our materials readily available as a reference. As always, please always, as far as contract tips, hints, special stipulations, forms, please always check with your own broker prior to using anything that you get in any class, whether that be through our school or any other school. You guys, Jay is back. I'm sorry. Sorry, Jay. Sorry, Wes. Wes is back to answer any questions for you guys.
Yeah.
If you have any questions, feel free to type them in the chat, or if you want to unmute yourself, you are more than welcome to do that as well. You've got about 5 more minutes.
Hey, I do have a question.
Yeah.
With the HOA, I'm sorry, the FHA loan that you were speaking of, that only required the 500. Would that be a question that we would have to ask the lender if they're putting on any overlays in order to protect them, or how would that go?
Well, I mean, you don't have to ask them. You can just ask them, do you have any overlays? What's your minimum FHA credit score? And that's what I would do. I would just say, hey, what's the minimum score that you guys require for an FHA? And that's really it. I mean, the reasons why is kind of irrelevant. I feel like, you know, but if you can ask them that, and they'll tell you, just so you know. I mean, obviously, if there's a lender that's you know, capping you out at 680, well, you're losing a lot of potential buyers, you know, Yeah, and really just the buyers. And I would think that you probably want somebody who's, who's going to be a little more aggressive, just so you can maximize how many people that you can work with. So.
Right, because I had a client, and I think her credit, she told me that her credit score was in the 580, which would make her eligible for the FHA loan if it's that minimum of 500. But he didn't even suggest that. He just said that he wasn't able to help. Yeah,
well, so and that's what you get a lot of times, especially right now, because lenders are busy, and they're busy with refinances. Which I mean, a lender that's a savvy lender will understand that you don't build your business off refinances, because refinances go away as soon as as soon as rates go up, because people don't refinance when rates are a little higher, and eventually rates are going to go up. And you've got bukudos of people who have refinanced now into 3% rates, some of them in 2% rates, right? So what you can't do is you don't ever let your purchase business die. You always have to prioritize your purchase business, and refinance people just need to understand that. They just kind of have to say, look, people are trying to get the house on purchase businesses. Refinance is just sort of a, hey, we're going to save money. What they should have done there is they should have said, hey, you know what? This guy's got a 580 credit score. Let's see what we can do to maybe get him up. He's real close. 40 points is normally something that you can at least say, hey, maybe not right now, and give us a couple months. And that's something that I know that we do, me and my team. I have a little 3-man team that it's me and my brother, who's an originator on my team, and then Asher, our assistant. And we'll look at it, and we will make sure that we get a customer's credit score up, because that's just kind of something that we do. So.
Right, and I even asked if he could speak to the client and maybe give her some suggestions, because he'd already pulled a credit report. So look at her, her credit and see, maybe she can pay something off here, or, maybe she can, at least give her some sort of feedback, something that she can do to kind of up her credit score. But he didn't even do that. So I was like, okay,
really?
Well, that's the last time that I'll use him, because, one other person that I used, he actually went and, in detail, like, okay, if she does this, if she pays this off, it could shoot it up. If she works something out with them, it could, he went through each scenario. But this guy, he was just like, I was disappointed.
Yeah, that does fit. Was it a buyer agent, or was it a buyer that you were working with, or was it a?
It was a buyer.
Okay, and yeah, that's disheartening. Again, there's a lot of things that you can do, especially with somebody who's got a 580 credit score. Typically, that's somebody that you can work with and get them up, even if it does take a little bit. To me, that's business. That's not somebody that you can absolutely turn into to a viable loan. And even, I don't know that I've ever just told somebody no. I've just told people that I had somebody the other day. If you've got installment rates that are real recent, that becomes problematic, and you have a low credit score. And it kind of goes back to what we just went over, manual versus automated underwriting. Well, when you have to go to manual underwriting guidelines, the rules are with credit is you can't have any installment rates. Now, the difference between installment rates and regular rates, and I'll go ahead and we'll go ahead and kick this back in because this is very pertinent to FHA. The difference between an installment rate or the difference in what an installment is and what a revolving is. An installment is where you make the same payment over and over again. It doesn't really fluctuate at all. A revolving, revolves based on what the balance is. So an example of installment would be a mortgage. It would be an auto loan, maybe a personal loan, and things like this. Obviously, being that a lender, the mortgage is an installment loan, of course, the lender is going to look more heavier at an installment debt. And if you've got an installment 30-day late or more in the last 12 months, you don't qualify for a manual manual FHA loan. So you got to just really hope you get an automated approval, or you won't be able to qualify. So somebody like that who's got one real recent, well, I know, let's just say in July we saw, or let's say in August we had a loan. I'm gonna mute everybody real quick because I'm getting that. Okay, so let's just say in in July the customer had a 30-day late. Well, on an installment loan, and I know they're only going to qualify for a manual underwrite. Well, I've got to wait at least 12 months from there. So it's that scenario where you know you got some time there. And then if you have multiple 30-day lates in even over 12 months, they say you can only have no more than 2 30-day lates or 1 60-day late in the last 24 months. So if I've got somebody who's got back-to-back 60-day lates, and I know they're not going to get an approved eligible, so it's going to be a manual underwrite. You know, that one I know is going to be probably 24 months out. So that would be the worst case scenario. The worst case thing that I would ever tell somebody would be, hey, we're looking at 24 months here, you know? And again, that's where I like to set a reminder in my calendar to call them back, because I know that, and the question is, in 2 years, will I still want business? Well, the answer is yes, because I'm not planning to retire in 2 years. So in 2 years, this is going to be somebody who's viable so long as they follow those steps. And we've got, you know, calendar reminders to call people over the time, and we kind of check in periodically and that kind of thing just to make sure that they're doing all right. So yeah, so that's, it's disheartening that they didn't. It sounds like your other guy did it a little better. And then when you start getting really good at it, it's not just paying stuff down, is you can open up accounts and you can do all kinds of stuff, getting deletion letters on collections. And there's all kinds of fun stuff you can do to get people's credit up. And, you know, it turns somebody who maybe has a pretty good credit history, but just has a couple small things into somebody, or maybe has little debt. If you have a very small amount of credit experience, so I'm going to take, I have a family member, for instance, they were going to buy a house, and they had like one account, and then they had a very small collection. They had an auto loan that he had paid off. Okay. And he had one small collection. It was like a $300 collection on a credit card. And I about boxed his ears in too. Because I'm like, you let this $300 like affect your credit. But he paid that off. He got a deletion letter. His score went from 620 to 800. It was just insane, the difference it made, because he got that one bad thing removed, and then he had this only other account that he had paid on time for 2 years, and it had this drastic impact on his house. And he went from not even being able to qualify for FHA to being able to qualify for whatever conventional loan he wanted. So there's some things that you can do that can really, really help and turn a person who wouldn't qualify into a very eligible candidate. So any other questions? And I muted everybody, so if you want to talk, you got to unmute yourself again.
All right, I have a couple of comments. First of all, Carolyn Davis, yes, you will get credit. Margaret McNeil, you figured out how to type in the chat, so please retype in your name, email address, and real estate license number. So, Wes, thank you so much. Before we get started again, just like when there's an in-class class and there's a course evaluation, through Zoom, what we do is launch a poll. So in just a minute, Wes, surprise to him, is going to launch a poll that is going to be the course evaluation. Once it is launched, it's going to stay up for the remainder of the class. Once it is launched, Wes cannot relaunch it or we will lose all the answers. There we go. It's up on your screen now. Wes, don't hit it again or you can't launch it twice.
Okay, yeah, but can I so I'll just minimize it. It's fine.
So it says course evaluation. There are 4 questions. Once you answer all 4 questions, the submit button will light up blue and you'll be able to submit it. If you have technical difficulties, don't worry about it. You will see at the top, there's a little minus sign, a big box, and an X. If you can't figure it out or your computer's having technical difficulties, just either X out or hit the minus sign to clear it from the head of your screen. Again, you can scroll down and there are 4 total questions and then you hit submit. It is anonymous, just like it is when you take it in class. Wes, when you're done with class, there's nothing you have to do. It will automatically self-report everything. Don't end it. You can share the results at the end if you want, but just don't end it. And any other questions, anybody? All right. Once again, back from break, please, if you have not already done so, type in your name, email address, real estate license number. If you are attending via phone, please type in your phone number as well. And I will put up one more time for reference, and this will take a few days to get up there, the website where you can go to get a PDF copy of the PowerPoint, as well as this video recording for your reference later. All right, Wes, awesome job. Russ will answer any more questions, and then he will continue on with the rest of the class. Great information, great information. Wes, also, if you'll comment a little bit about how our agents can help our buyers when they're quote unquote shopping for a lender, because you know, you'll hear one lender quote one interest rate and one another. So things with like lender credits and things like that, and how those have changed a little bit with COVID-19. And I know some things are tightening up a little bit as we head into the election. And just some comments to help our agents have an understanding so they can convey to really help buyers shop apples to apples and not apples to oranges. I think that'd be awesome.
Yeah. So that's a very good question and very good thing to cover. So the way that it works, what I always tell people to simplify it is there's only so many fees. There's really three places where fees come from. Okay. And you'll see this on your loan estimates. You'll see this on Good Faith. They really call them fee sheets now. But you've got your lender fees, you've got your attorney fees, and then you've got your third-party fees. Okay. So your third-party fees would be fees that are paid actually for a service, like your appraisal fee, your credit report fee, your flood cert fee, which your flood cert, in case someone ever asks you, is, you know, lenders make sure, we already talked about insurance. Well, the same way that they make sure that you have insurance is if you're in a flood zone, they want to make sure you have flood insurance. So what lenders do is they order a flood cert on every mortgage that they do. And it's just an elevation cert. It tells you if the home is in a flood zone or not. And if it was in a flood zone, they would require flood insurance. So, but those are three third-party fees that are paid. The attorney fees, are the attorney fees going to change really from depending on you know which lender you use? Well, no, they're going to be dictated based on, normally the listing agent picks the attorney. I mean, it's in the contract. I assume that's how it works. But that's not going to change depending on which lender they use. Those fees are going to be the same. So really, when they're trying to compare lender to lender, what they want to look at is that the top section of your, it's the left section of your, of the breakdown of the fees, and it'll tell you what the lender fees are. And there's normally only a couple. You've got your underwriting fee. Well, Homestar does an underwriting fee, and we do a processing fee. So I think it's like $1,200 or something like that, a total between the two of them. And then those can change lender to lender, because and some lenders break it out on 3 or 4 fees. Some lenders have just one like large fee that they charge. And then you have what's called discount points or lender credits. So the way that rates work, and rates change daily and sometimes in the middle of the day. They're based on, they're tied to the 10-year bond normally. And what happens is, you know, every day there's another rate that a lender says, okay, well, these are the rates that, this is the rate today that we feel like is just what's called the par rate, meaning we're not going to give a lender credit for this rate, and we're not going to make the customer pay any money for the rate, okay? The lender basically says, you know, but if the lender's willing, if the customer is willing to take a higher rate, we'll pay them some money up front because we're going to get more money over the life of this loan. So they'll give what's called a lender credit, and that credit can't be used towards your down payment at all, but it can be used towards closing costs and prepaids. The reverse applies too. If the lender, if the customer wants a lower rate, the lender says, okay, well, we're going to get less money over the life of this loan, so we want more money up front. And the lender will allow the customer to do what's called buying down the rate. So that's if they charge them discount points to go to get to a lower interest rate. What we try to do with Homestar, we try to present the customer with several options, and we have a whole like presentation that we do. I don't know if Jay does this or not, but I know my team does. I've just found it's been very helpful. It just gives side-by-side comparisons. And what you see is as the rate gets higher, your closing costs or your cash to close gets lower. And as the rate gets lower, your cash to close gets higher. So that's it in a nutshell. You know, now what I don't like is when lenders kind of plays tricks, and they'll maybe give a real low prepaid amount in there, so it makes your total cost look less. But the truth of it is, the prepaids, those are done the same every lender. Those don't change. So lenders have to collect the right amount of money. They legally can't have too much money in their escrow account, and they can't have too little money in the escrow account. So that amount is not going to change lender to lender. That amount's going to be the same. So what you're left with is, like I said before, those lender fees, which is going to include your discount points, any money that's needed to buy down a rate or credit, and then your lender fees. That's the simplest way that I can put that. So does that make sense? Anybody have any questions about that they want to ask about in the box? I think that's pretty self-explanatory, but or pretty easy. I don't think there's anything super complicated, but maybe there's just something that that stuck out to you had a question about. But yeah, that's it. It's a good thing to understand. It's good to understand how rates, because sometimes people will say, hey, my closing costs were way higher with this lender. Well, okay, what was your rate though on there? And all lenders' rates are pretty close. They all have slightly different profit margins they keep. What I found is that the lenders with lower rates, it's because when I say lower, they might be an eighth lower to like a quarter. You normally don't see huge swings. It's very rare that I see a rate that's, a half lower than ours. That's just so rare. Normally you'll see it with a bank. And the reason that banks have lower interest rates is because they're set up for price. They're not set up, banks, when they have loan officers, those loan officers don't have to be licensed, and they can fall under the bank's license. And the bank basically says, hey, you're falling underneath our license. We're not going to pay you as much as we would for somebody, let's say, it had to be licensed. So they typically it's not always, but they tend to be not quite as seasoned loan officers. And we talk about those income things where they're not going to catch. They're normally not. They're not going to catch some more complex stuff. Doesn't mean that they're not competent at doing it. They're just generally not as seasoned. And I say that general because my older brother, he works for a bank, and he's just like, look, I don't want to go out there and get business. I just want the business to come to me. And so that's just kind of his approach at it. Now he's very good and he does know his stuff, but he makes a significant amount less money just because that's just what his choice has been. So that's where, when you see the difference on that, it's because, a lender like Homestar, we're set up for service. We try to make sure that we can close loans quickly, and we're staffed up, and we pay our people, we pay our underwriters, we pay them, very well, because we want to make sure that we can get y'all to the closing table on time and that we don't miss closings, and that's kind of unacceptable. So when you see differences in pricing or difference in rates, that's why. Some lenders are set up for service, some lenders are set up not for service, but they're just set up for rates. So that's kind of it in a nutshell. Go back to my screen sharing here. What are the current FHA rates? So current FHA rates are anywhere between, rates are tiered. And my name, by the way, Victoria, is Wes Barclay. That's W-E-S, last name is Barclay, B-A-R-C-L-A-Y.
Yes, why don't you, when you get a chance, why don't you type in your contact information as well in the chat screen so that everybody will have it should they need it.
Barclay. Oops, I should have known all the same one. Barclay. 678. And fc.com. Bam. Okay, so there's my email, my phone, and my name. So, okay, so the FHA right now, is there an average amount of lender fees? I'd say, I see lender fees, we're somewhere in the middle. I've seen them as low as like $900. I've seen them as high as $1,500. Like I said, we're at $1,200, so we're pretty much right in the middle. You're talking a few $100 difference between like your cheapest one to your lowest one. And typically the ones that have lower, they just adjust it in the rates. You can do lenders that have no fees in there, but what they're doing is they just have a slightly higher rate, and then they take that lender credit, they just pocket that, and in essence they pay off their own fees with that. So, okay, so the current rates in FHA, you're looking at anywhere. It's tiered. It's not just as simple as here's the rate. It's tiered based on your credit score. So there are pricing adjustments with that. So you know, like I told you, there's a certain rate that's a par rate, meaning it doesn't cost anything. There's no discount points it costs, or it doesn't pay anything back. Well, if you've got a real low credit score, there'll be a pricing adjustment to that. So let's just say the rate was 3%. That was the par rate for the day, but you've got a 640 credit score. Well, we'll say 620 credit score. Well, that represents the highest risk from a credit score standpoint, and there are pricing adjustments accordingly. So that what would have been a par rate for a 700 score is now going to be somewhere like, you know, it might cost 1 discount point, which just means it's 1% of the loan amount extra in closing costs. So if you got a $200,000 loan amount, that means they'd have an additional $2,000 of closing costs for that same rate. And again, that's just to offset risk. Okay, so let's get back into, so we already looked over, we were stopped at the FHA back to work. So FHA back to work allows for 1-year seasoning for any and all major derogatory credit, foreclosure, BK, short sale. So this is a program that's specific to FHA. It's you won't see it very often, and so I'm going to kind of go over this quickly for the sake of time. It must be able to prove 20% or more in decreased income. So this would be something where you had a massive decrease in income, and then you must also complete a home buyer's counseling prior to the loan application. So you can get by with less on the seasoning for a foreclosure, for BK, or for a short sale if you had, you know, late payments on a short sale. So FHA secondary financing can be provided by government entities, any kind of HUD approved not-for-profit, family members, or a private individual. This just means where you take a second loan in essence. So when you see Georgia Dream, that's what Georgia Dream is doing. They're just having a second loan behind the first, and that second loan is $5,000 for your standard. If you're in a hardest hit fund, it's $15,000, hardest hit area, I should say. And you can go to Georgia Dream's website, just Google Georgia Dream, and you can find out where the hardest hit counties are. I think there's only a few left. I think Carroll County is one of them. I think Douglasville is one of them. And there's like 2 others. I just can't remember what they are. Again, you can go to Georgia Dream and find that out. So there's a CLTV ratio, and what CLTV means is it's combined loan to value. So this is, you know, your loan to value will be your loan divided by the value. Combined loan to value will be your first loan plus your second loan divided by the value. So this guideline allows for DPAs, which DPA stands for down payment assistance. So that's what Georgia Dream is, Chinoa, some of these programs like that, which Homestar does do. Now the problem with these is that lenders don't make a whole lot of money. So if you're somebody who says, hey man, I got to find somebody to only do my down payment assistant loans, good luck, because most lenders are not going to want to do that. Generally what we'll do as lenders is that we'll do those if we're getting, you know, if you've got a good relationship and, you know, you're sending us other loans too, yeah, absolutely, we'll do the down payment assistant. You know, I'll do one down payment assistant to get a couple other non-down payment assistant loans, but it's just not, it's not a recipe like not a great way to build a business off of. So it's just kind of something you kind of keep in there to be able to offer. DPA guidelines are always more strict than standard FHA guidelines. So there's stricter debt to income ratios and things like that. So just keep that in mind. Georgia Dream Cliff Note. So here's just the kind of the gist of it. There are income limits, typically between $69,000 and $79,000. The max sales price is $250,000. Your debt to income ratios are tiered based on your credit. So if you got over 700 score, it'll take whatever the automated underwriting says. So that's kind of nice. Total closing costs are typically your typical costs plus 2% is what the closing costs are. So it's normally 2% higher to get a Georgia Dream loan. Well, 2% of a $200,000 loan, you're talking $4,000. So you're paying $4,000 to get $5,000, which sometimes that makes sense though. Sometimes it still gives the person, in essence, it's just kind of like they're financing in the down payment. So, and the nice thing is about closing costs is you can have the seller pay for the closing costs. You can't have the seller pay for down payment. So it allows you to kind of get that down payment. You can have the seller pay the amount for the extra 2%, and you're able to still get into the house with little to no money at closing. So Okay, appraisals. Appraisals must have an FHA case number prior to ordering an appraisal. It sticks to the property for 4 months, and this is the case number. And I'm going to talk about case numbers a little bit too. I'm going to back up. When we talked about the foreclosure dates, and they have to be it has to be 3 years from. We talked about when it's from. From is the date that it's recorded. So we're going to look at that foreclosure deed. But when is the end? When is the to date? To make sure that we have that 3-year period. Well, it's the date the case number is pulled. So lenders pull an FHA case number, and it's an identification number, and it's attached to the property address. So once you do that, once you pull that case number, it's attached to that property address for 4 months. So getting a case number canceled is a task. So it's not something where we want to be pretty careful with that. So and it'll show up on the appraisal too. So if there's already an FHA appraisal done, it has a case number attached. And if let's just say you had a buyer in there, they had an appraisal order, and all of a sudden they either backed out on the loan for one reason or another. For that next person who's trying to buy a house, they've got to use that same FHA appraisal. So that appraisal has to be transferred from the first lender to the next lender. So property must meet HUD minimum standards. Utilities must be on time of inspection. So in other words, you can't have its utilities turned off during the inspection. The water, the electric, all that stuff has to be on at the time of inspection. If not, the appraiser is going to list the appraisal as subject to, and they're going to have to go back out there and check it when the utilities are on to make sure the utilities are working. And that costs the customer another $150 for a re-inspection fee. So we don't want to do that. Any deficiencies noted must be corrected prior to the loan. So it's got to be done before we can get this loan insured. We do offer HomeStart allows for repair escrows. So they don't have any lender overlays with this. They can be added. They can be financed in. It's not included in the loan amount, but it is. You basically just goes into an escrow account, and then that escrow account can either be paid by the seller or paid by the buyer. Either one is fine. And you can only escrow for items listed on the appraisal. So you can't be like, okay, the appraisal said I needed to fix this big hole in the wall, and I'm gonna also get some carpet because I wanted to redo the carpet too at the same time. That's not how it works. It has to be things the appraiser noted were subject to. So the basic loan amount structure. So we talked about this earlier. We talked about the base loan amount. So the base loan amount is going to be on this scenario, it assumes the appraisal value is greater than the sales price or equal to the sales price. We all know if that's not the case, we have probably bigger issues, and there's going to be some renegotiating going on. So we're going to kind of focus on that. So the lender will use the sales price, and they're going to say 3.5% of the sales price. Okay. And that's going to be your base loan amount. So it's 96.5%, which is just 100% minus 3.5. So your sales price minus your down payment, that's your base loan amount. Or you can just multiply the sales price times 96.5%, and that gives you the same number. And then we talked about earlier about that upfront mortgage insurance is financed in. So what they do is they add that 1.75% of the upfront mortgage insurance, and that's your total loan amount. And that's what you see down there. BLA, which is the base loan amount, plus the upfront mortgage insurance equals the total loan amount. The maximum loan amount exceeds standard examples. So if the sales price is $100,000 and the appraised value is $100K plus, the down payment of 3.5% would be $35,000. Sorry, $3,500. That's $3,500. That means your base loan amount would be $96,500, but then you would take 1.75% of that 96.5, and then add that because that's your upfront mortgage insurance. Then your total loan amount would be $98,188. So, and you'll see that on the loan application too. If you ever see that on page 3, it breaks all of that down. So you can kind of see it has the base loan amount, it has that the dollar amount of the upfront mortgage insurance, and then it gives you the total loan amount. HUD REOs. So REO stands for real estate owned, and that means HUD owns the real estate. Just real quick here, in the chat box, can anybody tell me why, what REO, why HUD would own the house? Anybody knows? Anybody?
A repossession?
Yep. It's foreclosure. Yeah, that's what they call it. Yep. And I see a couple people say there, foreclosure is good. Those are all correct answers. So if you've got a foreclosure showing up on your credit, I'm sorry, if a customer doesn't pay and the lender forecloses, well, that means now the lender owns that, or FHA owns the home. So what happens there is that they will sell this, and they're just trying to get rid of this thing because they're not in the business of servicing loans and taking mortgage payments and all the rest of that. They're trying to get rid of it quick, and they'll normally sell the house at a discounted amount. So, and also willing to open up their guidelines a little bit, just because they kind of feel like, look, at this point, we're already stuck for the mortgage anyway, so we'll allow a lower down payment normally because we just need to get rid of this home, because it's better than, even having a lower down payment is better than us stuck with it. We're already in plan B right now where we own this home, and that's not what we want. We want to get out of this and get back to plan A. So no changes, differences from standard FHA financing. So in other words, everything else has to meet the same income assets. But where you get away, where it gets into a nice situation for a buyer of a HUD REO is you can get away with 100% down payment usually. And that's versus 3.5%. Well, 3.5%, we'll just say of a $100,000 loan, or, well, actually we use $200,000. That's $7,000. Well, $100, we can do quick math there and know that's $6,900 less that the customer has to bring down. I mean, in essence, this is a 100% program. I mean, that's just kind of the reality of it. There's just not a whole lot needed. So your max base loan amount will be the lesser of the appraised value or the sales price minus $100. So that's how they get the loan amount. They just take sales price or appraised value, whichever is less, and they subtract $100 from that. You can do a repair escrow up to, it says 11,000 here. I'm pretty sure that's moved up to 15,000. I need to update that slide. I didn't catch it. That was off. And it can be financed into the loan amount, which is nice. So you can actually go to a higher amount and you can take all these repair escrows. Normally these homes have some issues with them. Normally these homes, people just don't take care of the house. They're leaving, so they're like, I don't care. And, they just don't, there's normally repairs. A lot of times the house has been sitting vacant for a while, and that can become problematic when you don't have any kind of, there's no really protection from the elements, temperature and that kind of stuff. So the lenders allow for $11,000, and you can do a lot of work for $11,000. So when they do that, when there's a repair escrow, what they typically want are invoices from whoever's doing the work. And it just kind of gives you, they want to make sure everything's legit, and then they hold the money in escrow, and then they'll pay out the person accordingly. So cash to close, it's only $100 down, right? Yes, but just like I mentioned before, what a customer is responsible for is the down payment, and then any closing costs or prepaids not paid for by the seller or the lender. So you have closing costs, and then you have other things like earnest money, utilities, the cost of de-winterizing or appraisal. Now, what's nice though is if you can get the lender the current owner to pay for all the closing costs, which is kind of hard to do with FHA. I've only seen it happen a couple of times. Normally they have a certain amount they're willing to pay, because remember, the owner is FHA. This is a HUD REO, meaning HUD owns this property. So, but if, let's just say you could get them to pay for all the costs. So let's just say you could get the lender, you took a higher rate and the lender paid some of the closing costs, and you had $1,000 earnest money down on it, but all the closing costs were covered, and all your responsibility was for this $100 down. Well, you would actually at that point get a refund. The borrower would get a refund for $900, the difference of that $1,000 earnest money and their $100 responsibility. So they could theoretically get an actual check at closing for the difference of their down payment and what money they had already given as a deposit. Cash to close, the initial list price of $105,000. This is just an example, by the way. Let me minimize this. Your initial list price, let's say it's 105, your sales price is 100. So your appraised value is 105. The base loan amount is going to be $999. it's $999,500, which is $100 less than the sales price. The closing costs and prepaids are $4,000. The lender the seller is going to give $3,000 of closing costs. So can anybody tell me what our cash to close would be needed in this scenario? I'm going to stop sharing here for a second. Can anybody tell me? I think I lost that screen. I'm going to hold on me. I'm going to bring that back up, and then I'm going to give you guys a second, see if you can figure that out. Okay, so we've got base loan amount $99,900, closing cost $4,000, seller paid closing cost $3,000. What is the cash to close that the buyer is going to need to bring? That's my Jeopardy theme music, I think, right? That's Jeopardy, I think. I don't know. I'm kind of old, so I'm old enough to remember that when that show was thing. Okay, let's see what you guys got there. I got 1,000, I got 1,100, got 3,500. The answer would be 1,100 because you've got your $100 of down payment, and then you have $1,000 of leftover closing costs. So those of you that said 1,100, that was the correct answer. And Dana will be sending you guys all a $1,000 gift card. No, I'm kidding. That's a total joke. Somewhere Dana's muted, cursing me right now. No. All right. Okay, there you go. $1,100. All right, moving on. There's another scenario here. This is the same thing, and the final answer is also $1,100. The answer to everyone, to every down payment scenario is $1,100. I'm teasing. Just these two examples happen to be. So here's one where the sales price is $105,000. The initial list price was $100,000. So the initial list price was $100,000. Notice here that went down to the base loan amount still went to $99,900. So what it did, it listed off that initial list price. So for $100 down, and then the $1,000 cost that they had to. So it was the same thing. And the reason is because they're going to use that initial list price when they do this. When they look at the 100,000, that you can't go over that initial list price is what I'm trying to say. Same thing here. These are just all different scenarios. 100,000 sales price, 98,000 appraised value. Now this is a little different because our appraised value was less than what our sales price was. So at that point, we have to, the customer has to bring the difference there. And this is true with all mortgages. So we've got $100 down that they have to bring, plus $1,000 of closing cost extra that needed. And then they have to also bring that difference of the appraised value and the sales price. That's how we got to that $3,100 there. So it's just something you got to be careful for. Anytime the appraisal does not, it doesn't appraise for the sales price, the buyer is responsible for that difference. So that's generally a case. What happens there is there's some renegotiation that happens, and they say hopefully you're there before your appraisal contingency was up, and you can at that point you can renegotiate and say, hey, you know what, this didn't even appraise. That actually happened with my first house I'd ever bought, and the conversation I had with the realtor was, listen, I'm willing to give you full price, full value for this house, but the full value is not the purchase price, and that's kind of how I spun it. Okay. Let's go see if there's any questions, any more questions. Where is my, oh, that's because I'm still in my sharing mode here. Go back to view, present, stop sharing. Okay, money, that's right. Okay, everybody got that right. I found my computer, that's good. You noticed appraisals have not appraised for sales price lately. I have not. To answer your question, Wendy, she asked if I had noticed any appraisals not appraising for this sales price lately. I've only noticed it like maybe twice in the last 6 months. We closed 26 loans in July. I think we closed like 15 in August and 20 in June. So we doing a large amount of volume. Out of those two that in the last 6 months, we knew we were pushing the value. I mean, it was a situation where the customer was going to, the sales price we'll say was 200, and they said, well, boy, we need some seller paid closing costs on this one, and they had worked out where they were going to try to do it for 205, and then have the seller give $5,000 towards closing costs, and they were already pushing the value as is. And so it just didn't appraise. But again, I think that happens probably a fair amount. And there's only two instances where I've seen where the value didn't hit. Now that's Homestar. Homestar's appraisers are awesome. I mean, if we have a situation where we've just got a difficult appraisal, we just won't use them anymore. We'll put them on our kind of blacklist and kind of go away. But it's not just because we don't get the value that we asked for. We can't do that. HVCC prohibits lenders from being able to persuade an appraiser to go get a certain value. That's Home Valuation Code of Conduct is what that stands for. Let me go back to the share screen. Okay, repair escrows. So this is where we've taken the home did not appraise as is, and there's work needed to get the appraisal up to as is, but nobody wants to do the work because the buyer doesn't want to do it because they want to make sure they actually own the home before they start forking out money. The seller doesn't want to do it because they want to make sure they don't own the home before they start forking out a whole bunch of money. So the work must be for items that the FHA required. So the appraiser said the estimates are not set in stone. Depending on the scope of the work, we can issue half the funds up front. So if the contractor needs half the work to buy repairs, they can do that. To buy materials. The numbers can be updated. So that can kind of adjust. Obviously, quotes can change. You know, I tell you, I do a lot of home repair stuff, and until you start opening up things up, you just don't really know. You can kind of estimate, and that's just that. If there's any extra money, yeah, sorry.
I'm sorry. I had asked a question earlier. I think you missed it.
I'm sorry.
That's all right. So a lot of times we have where the seller is going to pay for carpet to be replaced in the home, not because it has to be replaced or because it was called out on an appraisal by an FHA appraiser, just because that's how they both want to handle it.
Sure.
So we've got that happening a lot, not just carpet, but other items too. So I'm seeing here what you said on an FHA, the work has to be for items that the FHA are requiring. So yes. What if we have the scenario where there are items on the appraisal that the appraiser calls out, but we also have other items that the seller has agreed to escrow an amount of money to replace carpet or paint or whatever? Yeah.
So it's not allowed. I mean, that's the short lender answer of it. And the lender, if they see an amendment with that on there, they're going to start asking what that is. You can't, in other words, you can't hold back money and then have them do it after closing. Does that make sense? Without it being like a repair escrow. So in other words, they can't have it there. I guess the better way to say it is it can't show up on the HUD where they're just giving them a bunch of money. Now, what they can do is say, okay, we'll give you more money towards your closing costs and then help there. So let's just say they were doing $5,000 of an allowance. Well, you can't really do an allowance, but you can say, hey, you know what? Here's $5,000 extra towards your closing costs, which reduces how much money you're going to bring to closing, which now you can use to go buy new carpet. Does that make sense?
But essentially, if they're already paying closing costs, then there's no ability to really So essentially, on an FHA loan, you cannot do repairs in escrow. Unless
I can tell you what
is called.
Yeah, so I can tell you what the lender is going to require, because I don't want to get too, it can be kind of a slippery slope. If the lender sees an addendum on there, they're going to have an issue with it. So, and the contract. And I'll tell you, one of the big mistakes that I think realtors make is they'll give the lender, they'll have an addendum in there that they don't want the lender to see that has something just like that, you know, hey, you know, there's like a side kind of thing, and it'll be like, let's say addendum 2, okay, and there's like, well, we just won't give this to the lender, and then they send in addendum 4 to us, like it's extending the closing date or something. Well, if the lender knows that there's an addendum 4, guess what they're going to ask for? Addendums 1, 2, and 3. Okay, so then they get busted. Now they got this addendum that they've got to do something. They've got to either take off or they just got to kind of have a side agreement, or so. I don't know how the realtors handle it at that point. But from a lender standpoint, they can't allow that. But the lender typically, you know, they're going to know we're going to ask for the addendums that we see on the exhibit screen that, you know, on your, what's it, page 6 maybe of a purchase contract where it lists everything. We'll ask for anything that's on there. And then if we have something shown there's an exhibit 4, we're going to ask for exhibit 3, 2, and 1 also. So I think I had a realtor one time that he said that he doesn't label his. I don't know what the, you know, there was one, or maybe he doesn't do it as an exhibit. There was some way that he had kind of got around it, but that's, you know, again, I can kind of tell you what the lender can allow, you know, for how you guys get creative as realtors and contracts and stuff. I'll let you guys do that in like your own meeting. So, but like I said, from a lender, if they see that, they'll have issues. They'll call it an inducement to the purchase contract, and then they'll make a dollar for dollar reduction from the sales prices. How they do that. It's it's right there in FHA guidelines. Okay, so can be used. Where was I at? Okay, if there's extra money, it will be used to reduce the loan amount. So if there's any extra money, they just do it towards the loan amount, and it's just less money that the customer owns. So in other words, we repaired escrow for, you know, $11,000. The repairs cost $8,000. Well, at that point, we'd have $3,000 that we would just put in escrow. Sorry, we would pay down the loan amount with. That can be used for both HUD REOs and standard purchases. So it doesn't necessarily have to be an REO, but the appraiser does have to note it. So that it was needed to get the property up to an as-is property rating. Up to $11,000 on HUD REOs, and then $5,000 in standard purchases. And again, I meant to look for that on this break. I'll look at it on the next break that we do. If we get to the next break, we're somewhat running out of time. We've got 45 minutes. And let me see here. Where are we at? We're at 31, and we've got 42. Yeah, I think we're doing well. And like I said, I'll go look that up. And actually, I'm gonna do one more small break here, and I'm gonna look that up while we're doing that. And if you guys want to give me, we'll do 5 minutes, okay, and then we'll come back, and then we'll kind of finish up everything. We'll start with these FHA changes, going from the 4155 to the 4000.1. Let me check and see if anybody had any questions. Okay, we did have some. Can you go up to 6% paid by sellers? Yes, Charlene, you can go to FHA. That was one of the slides at the very beginning. Is you get up to 6% is what the seller is allowed to contribute. If CC is max, can you lower the contract price? Yeah, absolutely you can. If the closing cost is max, typically what I'll do, you get better bang for your buck to buy down the rate. It makes a bigger impact in your payment, and you pay less interest over the loan. So that's something that somebody who, it's not even being a savvy loan officer, it's just understanding numbers. I kind of dork out when it comes to numbers. So I don't know why, I enjoy, I've got a very analytical side. It's the underwriter in me that comes out. But I will present it to customers and just say, hey, look, you can pay down your balance on this thing, but that's going to affect your payment maybe $10 a month. If we buy down this rate, with using that same amount of money, we can buy it down a quarter, and now you're saving $30 a month. So it's a $20 more a month saving to do that. So, okay, I'm gonna look up guidelines real quick. And actually, for those of you who are kind of still here, I'm gonna share my screen here. You guys can see how I go to the guidelines. You can literally just type in for HUD 4000.1. Just make sure it's always the HUD.gov site that you're going to. And let me go to share screen, and we'll go back to the same screen here. So what I'm doing for you guys that just came back on is I'm going to go look at the guidelines. This is going to be a great example of how you would look for the guidelines. So I'm going to go 4000.1. Oops, not 400. And right here, first thing that came up, SFH Handbook 4000.1. Notice the site is HUD.gov. You're on the right track. And notice I didn't have to type in my special secret security answer or anything like that. The CIA is not monitoring this, and they're not going to kick down your door if you get in here. All right. And I want to go to the PDF version just because I just like that version better. It's really easy to control F and find And this sometimes does take a second to upload. Hopefully it doesn't take too long. Okay, it normally does not take that long. But you know what? See, I do this. I get married to this Internet Explorer, and I shouldn't be. Let's go to stop sharing. Let's go to here. And I'm going to see if I talk on it. Okay. Oops. Okay, let's try it this way. Can everybody see my screen right now?
If your screen is blank, we can see it.
Okay, do you see this? That says HUD.gov?
There you go.
Okay, good. Just want to make sure that I was on the same thing. PDF. And I'm going to 4000.1. Internet Explorer. I just have gotten in such a habit of always using Internet Explorer, but it just goes so slow. I need to get my mind into Chrome. Okay, so I'm going to go Control F. That's going to give me a little fines, and I'm going to say escrow, hold back. Or I'm going to say repair escrow. And now I don't have to sit there and take anybody's advice on it or anything. I'm just going to search. If I can't find it there, I'm just going to try to find that keyword. It's still uploading too, so I'm going to give it a second. See that little blue line? Come on, you can do it. Bam, there we go. Okay, so I'm going to go to repair escrow requirements. Bam. Section repair escrow requirements. There's actually quite a few of these. Escrow sweat equity. So I'm just going to see how there's 39 different hits. Is that what it came up with? Completion requirements. I'm looking for that dollar amount. Mortgage must execute. Okay, must certify. Close in. Okay, bam, here we go. Okay, the following table shows inspection and repair escrow requirements that apply to mortgages on properties that have not yet been closed. So repairs above 5,000 are completed and inspections with interior. So here, I mean, this is like all the information that we're looking for right here. Damage distance above 5,000 for the property. Well, let me see, I'm gonna keep going down a little further. Environment. But you can see, you can just like see all kinds of information on here about the repair escrow. You can kind of see where. So here we go. So for 203, for just a regular one, and I thought this had gone up, and I was correct. The HUD REO property does not meet HUD NPRs. Oh no, I'm sorry. It was actually accurate. I was wrong. But if repairs of no more than 10,000 are completed, the HUD REO property would meet HUD NPR. An escrow account to complete the repairs necessary to meet the NPR after closing is required. NPR is just minimum payment required. I'm sorry, minimum property requirements. I'm sorry, but it also does have to meet the. Okay, let's keep going. I want to see if. Okay, here goes getting into the $100 down program. Repair escrows. Trying to see what the actual amount is. And then our 5 minutes is almost up. We'll kick back into it. For those of you just coming on while we were doing our little break here, I wanted to go in and see just to confirm what the max amounts were, and it was $10,000 is the max. Including the 10% contingency must not exceed $11,000. So actually it's $11,000 here is a 2 or 3. I'm sorry, that was incorrect too. So here it goes, breaks down to the exact amount and what the maximum is. 11,000, 2 or 3K. So anyway, so that was actually right. Our slides were right. I was thinking that was outdated. There's more than 10,000. Okay. All right. So let's go out of this and let's finish up here. So we've got about 30 more minutes left. Let's finish strong. I want to see a lot of cheering. I want to hear a lot of applause because it helps me to, you know, just kind of gets me going. Just teasing. All right. Let's see it. Can you lower the contract price? Okay. So we answered that. Answered that. Let's go back up screen share. Oops, I need to go back into here, but I need to close this out, go into here, view, present. Okay, so here's some of the changes. From 4155 to the 4000.1. Oh, is everybody there? No, I think I just, hold on one second, let me. Give me just one second. I think my earbuds went out on me. Okay. No, it wasn't your hearing aid. Okay. Let me display. Blue. Okay, let me see if this is working now. Can everybody hear me now? We can hear you now. Great. Okay. Sorry about that. Yeah, thank you so much. Yeah, no, I need this one. Yeah, thanks, man. Okay, so I've got not, of course, my earbuds, which never go out, went out right in the middle of this. I don't even know why that even happened, but it looks like they're working now, and I've got some plugins if I need to. So let's finish up here. We've got, let's go do share and go back to our changes. Okay, so the 4000.1 consists of two separate sets of guidelines: total scorecard loan and then manual loan. So what they did there is they broke it out so that way people could understand you know, what the difference between a automated approved loan and then a manually underwritten loan. Okay, there's no way to discuss every change. It's just been a lot of them, but kind of just go over some significant stuff. Just when the FHA case number, the way they did that, it kind of goes back to what I said before. Now everything goes off that FHA case number date. Well, we already talked about it's hard to cancel an FHA case number. So it's so important that if you've got a foreclosure, that we know the exact date of that foreclosure hitting. Because if we don't have that foreclosure deed, then we don't know when to pull the, let's just say we have a foreclosure deed, and then the foreclosure was recorded 2 years and 11 months ago, and we pull that FHA case number, we don't have our 3 years. So now we're stuck trying to cancel an FHA case number, which takes time. And then after that, then we can start, we can wait until we have the full additional month, and then re-pull a new case number. So that can really create some delays there. All right, so the student loans, that's another one. This is the one I probably see more than anything. Back in the day, you could just exclude student loans because they were deferred, and customers tell us that all the time. Well, I don't have to make a payment on there, so I'm good, right? And that's not the way that it works. FHA requires you to use a 1% payment for qualifying purposes for all student loans. Now, does that mean that they actually have to pay 1%? No. It just means when you qualify, you have to be able to afford a 1% payment. And a lot of times you've got $100,000 of student loans, so that's $1,000 of payments that we have to add into our ratios. Okay, so back to the FHA case number. Case numbers are assigned to the subject property. For years, the main feature of a case number was just to prevent multiple appraisal orders. So the actual pull date didn't really affect anything like it does now. Now, as of September, and this has been the case for a while, they're significantly more important. Almost every date of concern, meaning your BKs, your foreclosures, how long you've had 2 jobs, all those things are done off your case number. So they can be canceled, but it's like climbing a mountain, or moving a mountain, I should say. So the old rule was you could be deferred for 12 months, no payment. The new rule, like I just said, you have to count the payment in there. So it can really wreak havoc on ratios. Newest rule is it's 1% of the outstanding loan balance, or whatever the reported payment is on the credit report. There is a little caveat to that. If the student loan, if you can show that the payment fully amortizes the loan, in other words, if they just paid that payment forever, that would actually pay the loan off in the term that it was there for. At that point, you can use whatever that payment is. Okay. Undisclosed mortgage debt, like a private mortgage or a mortgage in a BK, 30-day accounts, authorized users, identity of interest. So in other words, non-arm's length transaction. Oops, let's go back. A landlord, the 30-day accounts is what we talked about before with qualifying. They look at installment loans a lot heavier than they do a regular loan. And then they look at these 30-day accounts, the accounts where they typically pay everything off. They don't just like allow that anymore. They either make you pay it off, or they're going to count a 5% payment in there, which that can be an issue. So undisclosed mortgage debt. If you've got undisclosed mortgage debt, they will move that into a manual underwrite. So that's a shift. Mortgages in a BK, that's another thing that they changed with the 4000.1, and we talked about that earlier too. So identity of interest. So if you are a landlord on a house and you're selling to your tenant, if they've been a tenant for 6 months, you're good. If they haven't been a tenant for 6 months, the max LTV is 85%. So that's something that you want to discuss also. A 203K loan. Let's get into those. So you guys know that 203K are like rehab loans. It's where you can basically, there has to be a 203K eligible home, but you can wrap in. If you got a house that's it's just a nightmare, it's a bunch of issues, you can roll in all of the costs of the repair. And you can really, if you can find a good deal on these things, you can really make the home what the buyer wants it to be. The projected costs replace the sales price. So you would take the sales price plus whatever the projected costs, and the way they get that projected cost is they get they get the invoices from whoever the contractors are. And they add up all those invoices, and that's what the projected cost would be. They add that to the sales price, and then that's what your value is. So the people who do the work, the contractor has to be licensed and insured, no like, do-it-yourself type business, or, hey, my brother, he's done this once, he can do all the work. That's not how it works. So there's not a lot of investors. This kind of goes back to what I was talking about before with why, lenders went up on credit scores. So because we have less investors for FHA these FHA 2 or 3K loans that we can sell to, we have a little stricter overlays. So we require a 640 minimum credit score. Our debt to income ratios, we don't allow to go to 45, and there's no sweat equity. Okay. Energy efficient mortgage. Now, I've actually personally done one of these energy efficient mortgages. I did it on a house that I had. It works on all FHA loans. And that includes HUD REOs. And the buyer can finance 100% of the cost of making their home energy efficient. Now, the way they do these is they have a HERS, which is a home energy rating specialist. That person comes out and they make sure that you can save enough money to justify the costs of the energy efficient package. So the cost of improvements, including maintenance, is less than the present value of the energy saved over the useful life of the improvement. So in other words, they want you to be recouping the cost in lesser of the time that you're going to have this house, if that makes sense. The borrower does not have to qualify for additional financing or provide additional down payment. And this is where we get into HERS. The home energy rating system, HERS, is used to determine the costs of the improvements and the expected energy savings. It must be developed by a qualified home energy rater. Cost-effective energy packages is added to the loan amount. So the cost can exceed the greater of 5% of the value, which is max of that is $8,000 or $4,000. The one that I did was $8,000. It can be added up top of the FHA max loan amount. So you can actually go over the max loan limits by putting this amount in there. The chances of that happening are probably pretty slim, but just a good thing to know. It must be completed within 90 days of the closing, and a final inspection is required. So, and I'm going to go stop sharing. Go here real quick. Bear with me, see if there's any questions. Sounds like everybody's able to hear me. Any questions on that? Let me see if any questions I missed. I'm making any sound. Let me go down a little bit. 2 new messages. Can you put an email source page back up? Yes. You put the email source. I'm not sure what that means, email source. Can you provide your contact information again? I can. Okay, yeah, 1 second. Ms. Barkley. Oops. I do, no. 561. Barkley at homestarfc.com. There's my information again. And that number, just so you know, that rings to my team. So it rings to all of us, and we try to make sure that we're answering the phones when people call. Obviously we're able to help a lot of customers in, but that also means a lot of phone calls. So if we ever don't answer, just know that that's because we're on the other line. But I try to get back with people like real quick. From a pre-approval standpoint, I still not see your contact information. I just put it there. I don't see it. How is that not showing up? Okay, hold on 1 second. Let me, it'll be on this slide anyway. I'm actually going to change this right now, right before your eyes. This is my team number. And oh, Okay, so these are some great resources here. Search, nope, you percent. So go real quick. I'm gonna a couple of these. The home HUD store. So this is where, yeah. Somebody have a question? No. Okay. Go ahead. You want to go back to that? I'll leave that up there just for a second. Okay. All right, so the HUD home store. So this is where you can kind of see where there's any REO properties, and you can search through your county or just your state. You won't, I mean, back, man, in 2011, this thing was just full of foreclosures. Now you can kind of look in Georgia. I want to look in actually I just populated my address. My home is not for sale. But you can see all these homes here to tell you, you know, Glenn County, Forsyth County. One second, I'm going to plug these in. Bear with me just a second. Okay. Okay. All right. I should be back. Am I good? It's back. Good. I don't know why my only my earbuds are working. For some reason, when I plug in straight through, it's not working. But we'll be fine. We should be good. Okay. So somebody asked me a couple questions here. Let me go back up. When can we get the presentation? The presentation will be sent out. I'll have Dustin, who works on my team. He's my brother. He'll send that out. And then as far as the industry is concerned, how does the mortgage industry view energy loans for the future? Are they looking for you guys to learn more about them? So you see an increase of those types of loans, especially with climate change concerns. No, I mean, it's really, I don't think it's the mortgage lenders. I think it's really more the individual consumer's responsibility. And as you know, a mortgage company is there, not just a mortgage company, businesses around to make money. And as demand increases, and it really comes to more builders and more energy efficient people, really. But it's the individual. The lender can't coerce a customer into doing one thing or another. So it's going to be left to the individual to say, hey, you know what? Enough people need to want these to create a demand, and demand will create more production of these type of loans. These are available, but the mortgage lender is not going to force people into these loans. So, you know, that's kind of answers that. Now, how do I see it going in the future? Well, like I said, I already did an energy efficient loan. So obviously I believe in them. And I will tell you that my cost, I don't know if it was so much for, it wasn't for, I wouldn't say it's so much for global warming purposes per se. Not that I'm against treating our earth kindly, but it was I did this about maybe 10 years ago, And it was just, I was just trying to save some money. And I saw the benefits of having my utilities lowered for the life of owning a house. So I did that, and it, like I said, I was able to save, I mean, it was on average $100 a month. So that program is an excellent program. And for people who are, very atmosphere and climate conscious, it's obviously an excellent option. For somebody who just wants to save money, it's an excellent option. And it's really just a matter of that being presented enough, because I certainly like to present it. You guys wanted me to show my information again. 10 years ago, smart move, yeah. Okay, another great presentation. What's that? Oh, thank you so much, guys. I appreciate that. Okay, let me go back in here. I'm going to show you my information one more time. And then I'm going to go back to the HUD. I'm going to go back to these. There's my information again. Oh. These Zoom classes. See, normally when I do these meetings, there's like a lot of applause and whistling and, man, nice job, Wes. So it's a little weird not having anybody cheering me on.
Nice job, Wes. Excellent job. Oh my goodness. I learned so much.
And yeah, for those of you guys, for those of you guys who don't understand sarcasm, there is not normally applause and cheering and all the rest of that. But I try to make it as interesting as you can, make an SCE course. But for those of you who don't know, I have to take these courses as well. So it's not just, it's not, I have to take them to keep my license up. I think I actually have one. Boy, it might be actually this week. It's sometime coming up here. So I have to sit through these things too. I know how it can be. And, having it over a computer screen, I'm sure doesn't help. And I know none of you guys were multitasking at all. I know every one of you was focused on my screen only. So we'll just, we'll assume that that was the case. But, cause I know I wouldn't be multitasking. Here's my halo over my head. That was pretty lame halo, but, okay, so let's go through some of these, went to the HUD homes. You guys kind of see the deal here. This is an excellent resource to give, stop touching that thing. Hold on. Give me 1 second. I need this thing to move. There we go. So this is an excellent resource that you can take people to if they say, hey, I don't got a lot of money. I want to do $100 down, and they can go in there and make bids for these homes. A lot of good deals to be had. So we went over the 4000.1, but in case you need it again, I'm gonna search it. Again, this is the guidelines. This is where you can go and you don't have to take the word for it. But let's just say, the lender says, hey, man, look, your customer doesn't have enough overtime and we have to have overtime income for at least 2 years. I got to have this, they have to have overtime income for 2 years. And you can take their word for it if you want to, and maybe it's not worth your time to even go look it up. Or you can just do this really quick search here and just say, okay, well, let me do a search, overtime. Let me see what I can pop up. Well, there's 21 hits. Don't take very long to okay, well, here it is right here. And you look for these subcategories. Well, overtime income. And it says the standard, the mortgage may use overtime, bonus, or tip income as effective income if the borrower has received this income for the past 2 years and is reasonably likely to continue. Well, there's my answer. But hold on, let me finish reading. Periods of overtime, bonus, tip income, and less than 2 years may be considered effective income if the mortgagee is just a lender, documents that overtime, bonus, or tip income has been consistently earned over a period of not less than 1 year and is reasonably likely to continue. So there, you've just found the answer for yourself, and you all have brains. This is not rocket science. This is just basic understanding of English language. Okay, and it says it right here. It just says, yes, they want 2 years, but if there's not 2 years, the income can still be considered effective income if the mortgagee documents that the overtime, bonus, or tip income has been consistently earned over a period of not less than 1 year and is reasonably likely to continue. So if I've got a guy who's been earning overtime income for 13 months because he just started a job where overtime was basically guaranteed, and I can get a letter from that employer saying, hey, this income is probably going to continue. At that point, I can use that income. So Yeah, I love that. It's called reading. Exactly. And most people are scared to death to do it. Most people are scared to death to go and get it because they just want to hear from somebody else. The problem is that when you get information from somebody else, you play the telephone game. And we all remember from elementary school doing that little thing in class where, one person talks to the next person. And, you start off with one word. It's like, hey, hawks fly at night. And then by the end, it's like, hey, purple bunnies are fun. It's like, hold on, how did you get from there to there? It's just because as it changes subtly from voice to voice, the meaning of it changes. So what we don't want to do is we don't want to do that. So I would encourage you to go get those answers on your own. Just a couple more, and then we'll kind of wrap up with any questions. Okay, so that's the HUD. Let's go to, I'm going to close this out actually. That's the guidelines. HUD.gov is just kind of where you get all these things. You can kind of go and find what you will. That's the main government's website. If you want to learn more about some COVID-19 changes, any news updates, you can go there. Again, this is not secret classified information that only mortgage lenders have. FHA.gov is not one we really go to a whole bunch anymore, but you can go there and still get some good information from it. There's all kinds of stuff. You can go down there and tinker around if you want to. And then this is probably the best website, is my own personal, but no, this is actually a place that you can send people if they want to apply. What it does, it'll send them a little, it'll send us, it goes through our portal, and then we'll see that they've applied. You just click on apply now here, and then you click on apply now again, and then they just start filling out information. They create a profile with their password. And if you guys need to get a pre-approval, we typically try to get it within 24 hours. If there's something where, hey, I need this thing like right now, give us a call. And it doesn't matter what day. I mean, I'm working on Saturdays, Sundays. I was working yesterday. We do this obviously on Saturdays and Sundays. I would say that, let's say the open heart surgeries, let's say those for regular working hours. But if it's somebody is a pretty sure thing, and they're going to be able to qualify by pretty easily, then that's something that we can absolutely get you a pre-approval letter out that weekend so you guys can make an offer on a house. When I say open heart surgery, I'm talking about, somebody who they got a 500 credit score and we're just trying to do some credit repair. I mean, that's something that's not like time sensitive. We can wait till like a regular weekday to do that. And then that's it. Let's go to the next one. Any questions from anybody? Questions, and we still got a few minutes, so questions are welcomed. And if I need to take up more time, we'll go over some more guidelines from FHA. I'll look those up on the. Let me get out of this so I can see questions. Decide FHA or conventional. Does the site make them decide? Victoria, tell me explain that a little more. What does a site? What do you mean by does the site make them decide FHA or conventional? Well, let me just kind of give a little bit to that. It's the customer's profile typically is what determines FHA or conventional. Generally speaking, if you can go conventional, you want to go conventional because conventional is the cream of the crop. Okay. I see. What does the site that the HUD home to view the $100 down homes again? That will be the HUD home, and it'll tell you if it's 100. That's let me see. I'll pull that back up. Okay. Oop. Okay, it's this HUDhomestore.com. So I actually used that before I bought the house I live in now. There was a HUD foreclosure that I was looking at, so I was on that site constantly. So HUDhomestore.com. Better than VA. Okay, so good question here. Let me see. Let me go back to the conventional. So okay, so a conventional loan is typically for people with better credit. It has the interest rates are actually a little bit higher than FHA when comparing same credit score to same credit score, but your payment is generally going to be lower because FHA has 0.85% mortgage insurance monthly, and then it also has an upfront mortgage insurance of 1.75%. So while that is, financed into the loan, it's still a 1.75% fee, So conventional does not have that, and typically conventional's mortgage insurance is lower monthly. The other thing about conventional is that once you pay down your loan to 80%, the way that it works is when you pay your loan down to 80%, the mortgage insurance, you can call in and they'll cancel your mortgage insurance. If you don't call in, it automatically cancels at 78%. So the mortgage insurance goes away eventually. FHA loans, mortgage insurance never goes away. It's just always going to be there. So, when you can get a lower payment with a conventional, it normally makes more sense to do that than it does to go FHA. Now, some people just can't qualify for conventional. When you get to that 680 score, you can probably qualify for conventional, but the mortgage insurance is pretty high because mortgage insurance, unlike FHA, on a conventional loan, it's tiered based on your loan to value, based on your credit score, and then based on your debt to income ratios. So it changes. And if your credit score is 680, that amount is pretty high. It's normally higher than FHA's is. So if you have a lower rate with an FHA, you have lower mortgage insurance, then your payment is normally going to be lower with an FHA loan. The only downside is that you are paying mortgage insurance through the life of the loan. But history says that most people refinance or sell their home within 5 to 7 years. So, you're probably going to be out of that mortgage anyway before you ever get to the point where you're not paying mortgage insurance anymore, unless you're putting down a significant amount of money, in which case you're probably going to want to go conventional. But conventional is the superior product. Somebody asked about VA. So is VA better than conventional? VA's rates are typically better than conventional. VA requires no money down, and VA, the only downside, the only thing that conventional has over VA is that VA has what's called a funding fee, and I think it's what is it, 2.2? I'd have to look. I think it's 2.25%, or maybe 2.2%. So for initial uses, for subsequent uses, it's like 3.2. I think is what it is. So, but that's a huge amount of money that people have to pay, and typically don't want to. That you don't have to pay for conventional. Now that is financed. It's just like FHA's up.
Sound off. Sound off.
We can't hear you.
Can't hear. Can't hear.
Okay. Okay. So you guys can hear me now. I know.
There you are.
Yeah, these things are going to go dead. The good thing is these things charge real fast. I've never had it go dead this early in the morning. That's really weird. So we'll finish up here. We've got about 5 more minutes. Any other questions that anybody has? Is everybody pretty good? Houston, we have a problem. That's funny. Well, I appreciate it, guys. Appreciate the kind words and the presentation. Like I said, when we get in person again, which I'm not sure what Max One's plans are for that. But
I do have one question.
Yeah, go ahead.
I typed it in there. I don't guess you've seen it. If you have a less than an 80% LTV with an FHA loan, do you still have to pay all the insurance fees?
Yes, you do. It does not matter. You still have to pay mortgage insurance. It really stinks, but it's just kind of how they do it. It's how they finance stuff. So, okay. Any other questions?
Thank you.
I think now we type in our stuff again.
I do. With the VA loans, do they have to have a minimum credit score to use their entitlement?
No. Well, yes, I'm sorry. And that's the same thing with lender. They have lender overlays. Okay. So it's generally, we used to be 580 and that got moved up to 620 also. So it almost mirrors FHA's exactly from a credit score standpoint. Does that make sense? So, so there are credit score requirements, but like I said, the rates are typically better in conventionals. Now, that funding fee that I was talking about, that funding fee goes away if a customer has any kind of disability. What I'm finding is most retired veterans have some kind of disability because, I mean, let's face it, war wreaks havoc on the mind. You know, so most of them are suffering from PTSD, and man, God bless our military for allowing us to do what we're doing right now and giving us those freedoms. But you know, they take a toll. It takes a toll. And so a lot of them have some kind of a service-related disability. And at that point, the funding fee is waived. So now you don't have a funding fee, you have a lower payment and no monthly mortgage insurance, even if you're not putting down any money, no down payment. So VA is a superior product with the exception of the guarantee fee, the funding fee that they charge. But like I said, when you get somebody who's got some kind of disability, military-related disability, it's really, really tough to beat VA. So let's see. Do we need to type our license number? I don't know. I will defer. I think yes. I think you are supposed to type your license number.
Will the PowerPoint be available here?
Yes, we're gonna be sending that out. I'm trying to get that to Dana, and we'll work on getting that out. Somebody asked what's HomeStar's overlays. We really don't have hardly any overlays. We do have credit score overlays, so 620 right now, but we don't really do. It's so dumb that we even have any, because if I've ever had an overlay and I get a loan that you know that overlay is preventing from doing a home, I just bring it up to the owner, and the owner he takes my calls. Me and Jay work for the #1 team. Jay and I are like neck and neck. I looked at it. The difference of his and my volume for the year is like less than 2 loans for the year. I mean, we're like just super, super tight. And so when you do that, the good thing is that when you're in that top tier of producers, you can call the owner of the company and they'll answer your phone calls. So, but he absolutely will, and he'll just say, yeah, does this make sense? And if it didn't make sense, I wouldn't be bringing it up to him anyway. And I would tell my realtor partners, just saying, hey, you know what, this just doesn't make sense, and I got to make sure I have a loan that pays. So, but I think somebody asked the benefits again of conventional. Just kind of reiterating, there's no upfront mortgage insurance, and your mortgage insurance goes away when you're at 80% loan to value. Those are the 2 big benefits. So you typically have a lower payment. But that's all. I'm gonna let everybody go. Thank you guys so much for being in here and participating. So that was awesome. All right, cool, awesome. Well, if you guys have any questions, like I said, my contact's here. I'm gonna leave that up just for a second. And yeah, it's been great. You've been a great class, and hopefully we'll see you guys in class at our next in-class meeting. So y'all have a good day.
Thanks again.
Thank you.
Oh, no problem.
Thanks, Wes.
Yeah, no problem.
Thanks. Thanks.
You're welcome.